Morning. Welcome to the 14th SSM Round Table. It is a great honor for me to open this round table and to moderate the first session. My name is Günther Franke. I am from the University of Constance. Now, our host is the Irish Central Bank, and in particular, the governor, whom you see already here, Mr. Makhlouf. So thank you very much, Mr. Makhlouf, for hosting this session. And I'm very glad that you also will now give us a welcome, and you will also give an introductory talk to the current topic of the SSM, which is greening our economies, new chances for financial institutions. So please get started.
Good morning, everybody, and welcome to this 14th SSM Round Table. It's a real pleasure to welcome you and to host this event, albeit virtually. There's an exciting agenda today discussing the key issues of sustainable finance, sustainable business, post-pandemic regulation, and effective ESG supervision. And given that I have the honor of the opening remarks, I want to take a broad view of the dynamics of change in the financial system and the challenges we all face in managing both the process of change and the risks from the change itself. The other sessions will go into greater depth on the four key areas I outlined. Now, change is a concept that all of us are used to, and reflecting on the last 2 years, we all adapted very quickly to new ways of working, new ways of engaging, new ways of having conferences, simply because we had no choice. We had to change. And the financial system is always changing. But today's change feels different, and I believe it is different. Different in the pace of change and different in the extent of disruption it is creating. Technology, more than anything else, is the driver for change, changing how financial services are delivered, with far-reaching consequences for the structure of the financial system. This means change for everyone. Firms and regulators need to adapt to the changing competitive landscape. My remarks will touch on some of these issues: the evolving structure of the financial system, the unbundling and disintermediation of traditional financial services, and in particular, the growing participation of non-banks in retail lending and payments. And of course, central to the themes of this conference, climate change, a key emerging risk that we all face and which will have the biggest impact on all our lives. Now, as I said, technology is driving significant and rapid change. As our lives become increasingly digital, businesses are harnessing the opportunities to innovate and provide new products and services to meet consumer needs and preferences. The pandemic has moved this trend into an additional gear. A recent McKinsey global survey reported that firms have accelerated the digitalization of their customer and supply chain interactions and their internal operations by 3 to 4 years, and accelerated the share of digital or digitally enabled products in their portfolios by 7 years. For financial services, technological developments around digitalization, cloud technology, and blockchain are driving change and innovation in ways we could not have imagined just a few years ago. In the realm of payments, we've seen an acceleration of digital transformation with a surge in online transactions and contactless payments during the pandemic. The competitive landscape is shifting, with new entrants and new business models disrupting the entire value chain of traditional financial services. For my part, a big component of the change is the disintermediation of traditional financial services. It's no exaggeration to say that data is the foundation underpinning this digital revolution, and higher quality data will also be critical in how we move to better understand and address the risks from climate change. Now, many of these dynamics were evident long before the pandemic. Since the global financial crisis in 2008, the provision of credit, one of the most fundamental tasks the financial sector provides, has gradually been reshaped. Credit institutions' share of this has dropped some 14% across the euro area since 2008. Here in Ireland, the market-based finance sector has more than doubled from 1.8 trillion euro at the end of 2009 to approximately 5.2 trillion in the second quarter of 2021. Consumer behavior has also long been changing. Prior to the pandemic, the proportion of cash used by Europeans for their daily payments dropped from 79% in 2016 to 73% in 2019, and the proportion of card payments increased from 19% to 24% over the same period in terms of volume. And the unprecedented shock of the pandemic has accelerated the dynamics of change across the economy and financial system. How households and businesses interact with the financial sector will not be the same again. All across Europe, we see the growing popularity of new businesses who have been expanding their customer base, in particular for current accounts and regular non-lending banking services. This growth reflects how user-friendly their products are, as well as the efficiency of the payment and security settlement infrastructure that supports their activities. This also reflects the underinvestment on the part of banks and other traditional financial services providers over a number of years. Innovations in blockchain technology, although remaining relatively new and somewhat untested, have the ambition to reduce the need for intermediaries such as banks altogether. Innovation and changes such as these bring challenges, but we must embrace them. For financial service providers, embracing digitalization can help cut costs and promote efficiency and competition in certain segments. This should help profitability, which has long suffered in a low interest rate environment. A recent analysis using the Italian Regional Bank Lending Survey shows that during the pandemic, those banks which invested more in IT increased their lending by twice the rate recorded by other lenders. But it is worth remembering that in embracing digitalization, there are costs in the inability of less digitally advanced customers to access banking services and the increased threat posed by cyber attacks, for example. Now, the opportunities brought about by the speed and scale of technological change are matched by risks. The pandemic has led to a realignment in thinking. It's no longer a case of considering what if disruptions occur, but rather when disruptions occur. An operationally resilient financial sector is important for consumers, for firms, and for markets. Resilience allows us to plan, invest, and grow, and gives consumers confidence in the services which they rely upon. Firms must consider whether they have measures in place to limit the impacts of possible disruption and the capacity to maintain the delivery of critical services to consumers and market participants. Such disruptions can have many causes and sources. For example, technology failures, cyber incidents, pandemics, and natural disasters. The interconnectedness of the financial system and the extensive use of third-party service providers also means operational disruptions can have a systemic impact across multiple firms, sectors, and markets, putting financial stability at risk. Therefore, a flexible, pragmatic, and broad approach to operational resilience is needed so that firms have the ability to respond to and recover from unforeseen disruptive events. This should be rooted in the behavior and culture of the firm, starting with the board and flowing through into the governance and risk management frameworks. While the policy landscape is maturing, central banks need to maintain a high level of cooperation globally to ensure system-wide resilience is robust and keeps pace with the evolving environment. A balance must be struck between maintaining stability and ensuring resilience, but also allowing space for innovation that benefits us all in the long run. Now, many of the challenges, opportunities, and risks that I have spoken about emerge from within the financial system. Climate change, the focus of today's conference, is a risk that comes from outside the system, and it is a reality we cannot ignore. It requires action on the part of all participants in the financial sector, given the challenge to firms and the stability of the system overall. We must all get to grips with these risks and set out clear measures to tackle them. Greenwashing is an area I am particularly concerned about. So-called green market practices are currently almost exclusively based on voluntary principles and standards, which leaves a lot of room for different interpretations. There is a spectrum of risks here, from the accidental error to the deliberate misdeed. The challenge for those overseeing firms is to lead and drive the climate and broader ESG agenda within their organizations. In the Central Bank of Ireland, we too will play our part and lead by example in our own actions. Just last week, I wrote to all regulated firms in Ireland outlining our supervisory expectations regarding climate and other ESG issues. We've also established a climate change unit which will manage and coordinate our approach to these activities. And as I'm sure the audience knows, climate change was a key component of the ECB's monetary policy strategy review. And following the conclusions of the review earlier this year, climate change is being incorporated into our monetary policy framework. We are broadening our understanding of the nature of financial risks stemming from environmental change and how interlinkages across the economic and financial system might amplify them. All of us must act now so we do not let the next generation down. As we face the future, we know that the status quo is not an option. We all need to continue to evolve, to be front-footed in our response to these risks and challenges. We must change and transform aspects for all of our organizations to ensure we deliver. For central banks, for the public we serve, and for firms, for your customers. And for the Central Bank of Ireland, this change involves us being significantly more open about who we are, what we do, and why we do it. This strategic change means not just of the specifics of regulation when it comes to new products and technology, but fundamentally shifting how we think and how we operate. Early engagement with innovators, for example, is important. And this is one of the chief motivations behind central bank innovation hubs, which facilitate two-way dialogue on regulatory challenges associated with new innovations. And perhaps most important of all, in a time of rapid change, we need to be understood and trusted by the public. That is why we want to make a step change in the way we engage with our stakeholders and create additional opportunities and facilities for us to listen. Next year, we will host our first financial system conference, which will bring together industry, civil society, consumer, and business. And I will also chair an industry forum with representative groups. To be more future focused and become more open, we have to transform key aspects of the way we operate. This means a constant process of change right across the central bank, always asking how we can do things better. The evolving environment means we need to help people to do their jobs, to help us deliver more effectively and efficiently. It means investing in new skills and technology as we become digital first and leverage data to make better decisions. There are risks which we are thinking about that cut right across financial stability, consumer protection, prudential regulation, cyber resilience, and conduct. And the European regulatory framework has also needed to adapt to the changing structure of the financial system and in response to climate change. The challenge is to develop regulatory approaches that are consistent globally so that gaps or opportunities for arbitrage are identified and addressed, to ensure our regulation consistently supports the proper and orderly functioning of financial markets globally. We also need to think about whether our focus should be on regulating the activity or regulating the entity. However, for consumers and businesses, these structural changes should ultimately lead to reduced cost and greater choice in accessing finance and performing day-to-day banking. So to conclude, technology is driving significant and rapid change, leading to a transformation in the structure of the financial system. The great disintermediation of traditional financial services is underway. We must all adapt to maintain stability for communities and ensure choice for consumers. Climate change is the biggest issue we all face in our lifetime. The financial system has a key role to play in addressing this. The overarching challenge is how we manage change and manage the risks from change. This matters for sustainable finance, sustainable business, post-pandemic regulation, and effective supervision. For the Central Bank of Ireland, we are trying to be more open and engaged with our stakeholders and more future-focused in our thinking, actions, and policies. This is the best way we can keep pace with the changing structure of the financial system in order to ensure that it continues to operate in the best interests of consumers and the wider economy. We all will need to be flexible in the delivery of our strategies while prioritizing competing demands and in safeguarding the delivery of the fundamentals of our work. Remaining nimble when responding to new challenges and shifting landscapes will be critical as we face the future. Thank you all for your attention. I hope you have a very good roundtable. Welcome to Dublin.
Okay, so thank you very much, Governor Makhlouf. I think you showed us a huge agenda driven by much uncertainty. And it's an agenda for the companies, for the banks, and also for the regulator. And I think, as you said, there needs to be much flexibility in order to handle these issues, which we partly see now, but which we partly also do not see now. So we have probably a very strong learning process in front of us. Okay, so thank you very much. And now I hand over to Mr. Jatzenbeck. He is working for the International Bankers Forum, and he will give us some introductory remarks.
Well, thank you, Professor Franke, for your kind introduction. Ladies and gentlemen, a warm welcome to all of you to our 14th European SSM Round Table, hosted by the Central Bank of Ireland in Dublin. Our title is, as just mentioned, Greening Our Economies, New Chances for Financial Institutions. You are probably surprised that you were expecting the president of the International Bankers Forum, Dr. Nader Maleki, to be here at the moment. Unfortunately, I have to inform you that he is unable to attend at very short notice, and he asked me to open this event on behalf of the IBF. So let me introduce myself very quickly. I'm head of regulatory affairs at the International Bankers Forum with more than 30 years of experience in financial reporting, banking regulation and supervision, as well as risk management for banks. First of all, ladies and gentlemen, I would like to thank the Governor of the Central Bank of Ireland, Mr. Makhlouf, on behalf of Dr. Maleki and the entire IBF crew for kindly hosting this event. It's a great pleasure and honor for us. Your remarks are the benchmarks for this roundtable today. And as you just mentioned, I read it down, regulating the activity or the entity is a very important thing we have to talk about. We'll take a closer look at your insights and your expectations in the upcoming sessions. Deputy Governor at Sibley will reflect the Central Bank of Ireland's position in session 3. So we hope we will meet your expectations for the day. Also, I would like to thank the Frankfurt Institute for Risk Management and Regulation for its excellent cooperation. Today it's represented by Professor Franke, Dr. Paus, Mr. Grassoff, and Dr. Lehr. Ladies and gentlemen, in 5 sessions, we obtain up-to-date insights into ESG risks at the business activities of banks, the perspectives for capital markets, and the regulation and supervision of banks. We will discuss with bankers, banking regulators and supervisors, management consultants, RegTech service providers, and academics. At the beginning, please let me give you a few key data. In January 2021, the European Central Bank set up its Climate Change Center. In the whole year 2021, the EU Commission was very active. In April, it adopted an ambitious and comprehensive package of measures to help improve the flow of money towards sustainable activities across the European Union. In July, the EU Commission adopted its strategy for financing the transition to a sustainable economy, and at the end of October, it published the so-called Banking Package 2021. And now on the 3rd of November at the 26th UN Climate Change Conference in Glasgow, in short COP26, 3 important decisions and commitments were made. First, the central banks and banking supervisors network for greening the financial system has come out with a Glasgow declaration committed to action. Second, the finance sector's initiative, Glasgow Financial Alliance for Net Zero, has committed to using over 130 trillion US dollar in private capital to transforming the economy for net zero, and as well as to net zero balance sheets in 2050. And third, the IFRS Foundation trustees announced a new International Sustainability Standards Board to develop in the public interest a comprehensive global baseline of high-quality sustainable disclosure standards to meet investors' information needs. Here from Berlin, congratulations to Frankfurt, where IBF has its office, that Frankfurt becomes the seat of the board and the office of the chair. Ladies and gentlemen, there's a lot to talk about. I look forward for informative lectures and exciting discussions. Let me give the floor back to Professor Günther.
Okay, thank you very much, Mr. Jatzenbeck. You gave us an overview of some new activities, and particularly on the European level, which are really challenging the industry. And so it's a very good introduction to the further discussion. Okay, let me just now come to our normal presentations. Here we have 2 presentations. The first will be given by Bodo Windmüller. He is a Senior Vice President of Regnology, which is a company with lots of expertise in regulatory reporting. And he will talk about the topic, what is a green and sustainable finance, and give us an overview. So please go ahead, Mr. Windmüller.
Yes, thank you very much, Professor Franke. Ladies and gentlemen, a very warm welcome also from my side. I have the honor and privilege to use the next 15 minutes to try to give a definition what green and sustainable finance is, and that's not going to be an easy task. In the preparation of this speech, I have a little bit come to the conclusion that green finance is, in some aspects, like pornography. About which the famous US Supreme Court Justice Porter Stewart once said, when asked for a definition what it is, I know it when I see it. And I'll try to explain a little bit what I mean by this, and we could please move 2 slides ahead. The issue with the definition of green finance is that there is no common definition, and with different agents and different motivations, we see a various scope how green finance is being defined. On top of that, green finance is just one of a number of terms which are being used to label the broader area of finance to aim and to protect the environment. And we have heard already some of these terms being used by the governor and by Mr. Jatzenbeck, such things as sustainable finance. Now, if we can move 1 slide ahead, please. I'd like to try to give an overview of how different actors actually shape the discussion on what green finance is. And I do believe we need to start with the wider policy context and to start with the Sustainable Development Goals and the Paris Agreements, which have already been mentioned before, because they are the landmarks of the commitment of the international community to move to a more sustainable society and a climate neutral economy. And we have heard we need a lot of technology, different capabilities, a change maybe also in consumption patterns to reach those goals, but also a tremendous amount of financial resources will need to be mobilized in order to make this shift and this transition happening. So several initiatives have been drawn up, how to move the flow of money towards these goals. The UN bodies have been leading, and so we have seen the emergence of several guidelines and principles to investors and bankers, how to increase the impact of their activities towards SDG, and how to provide frameworks, for instance, for a sustainable banking system. On the other hand, in parallel and maybe even preceding, we have seen industry-originated frameworks having maybe their roots even in the 70s in the civil rights movements, in the environmental movements. And we've seen and we have heard it from the governor, ESG agendas are more and more at the core of many companies, and they provide a huge catalyst for ESG investment. And I'd like to point out the United Nations facilitated principles for responsible investment here. At some estimates, more than half of the total global institutional assets currently under management are managed by institutions which are formally embracing these principles, which is a huge commitment of the financial markets towards ESG criteria within investment decisions. And then we have a third area which also has been touched upon, especially by the governor, which is labeling standards and taxonomies. I think the most important labeling standard is probably the Green Bond Standard or the Green Bond Principles put forward by the International Capital Market Association in 2014. It's under this standard or under this label, we have seen double-digit growth in green bonds, reaching a level of $260 billion in 2019. However, it is believed that this only captures half of the market of bonds actually eligible under these label, as a lot of issuers do not bother to go through the process of labeling. So it's not really a good measure to see how much of a transition we are doing or having right now. And also the governor related to the greenwashing risk already. On the other hand, we can see the rise and the emergence of taxonomies. We see initiatives in UK, in China, in Canada, but foremost in the EU. And I'm going to talk more about the EU taxonomy later. I do not believe that we can overstate the importance of this taxonomy in terms of discussing what green finance is. And with the next slide, I would like then to try to give a definition of green finance. And I do believe we need to answer two questions in order to come up with a workable definition. First, what is green? And I'd like to propose that this is given by the environmental part of the Sustainability Development Goals. And the second is, how can greenness be achieved? And I do believe that we will see taxonomies driving the answer to that second question. And to me then, green finance is financing to support activities and sectors that contribute to the achievement or improvement in one of the relevant green goals. Now I'd like to spend the rest of my talk about with seeing how this is actually happening and working in Europe. And for that, please go to the next slide. It's already been mentioned by my speakers before me that the EU has embarked on a Green Deal. We want to move to climate neutrality by 2050. And an action plan has been put forward in 2018 with the aim to reorient capital flows towards more sustainable investments. We have seen the establishment of the EU Sustainable Finance Framework, which contains a lot of different pieces. The taxonomy I've already mentioned, but certain directives, a green bond standard, an EU eco label, and much more. In July, we have seen an update of this strategy, and especially a concern of the EU is that there needs to be more progress in the banking and insurance sectors. The identification and management of sustainable risk by banks and insurers are key for the EU's economic resilience and financial stability. And finding progress to be insufficient, the Commission proposes legislative changes to prudential frameworks, and we will see ESG factors included in risk management systems and supervision to a much greater extent than in the past. We will see exercises on climate change stress testing. We will see changes in capital requirement rules, amendments to Solvency II for insurance companies. We will see greater attention on disclosure, and EIOPA will also be asked to assess changes on which might be necessary for fiduciary duties of pension funds and investors to reflect sustainable impacts. Also, the EU is pushing for much more international cooperation and alignment. I think that's very important, especially on the front of the IFRS. There is a push to reflect sustainable risk in financial reporting standards. And lastly, the EU will work on strengthening the EU taxonomy. And if we go to the next slide, we can see already that EBA and the ECB, and the governor already mentioned most of these actions, have put forward concrete action plans on how to accelerate that shift towards a more sustainable finance. Notably, I think that from the EBA, the most important initiatives are currently on the disclosure of ESG-related risks. And on the other hand, the inclusion of ESG risk in risk management and SREP. In June this year, we have seen a report by EBA, and this clearly steers supervisory expectations and already hinted that there will be future guidelines on this topic. And I do believe this will move from a voluntary exercise to a much more strict regulated undertaking. On the ECB action plan, the governor already pointed out most of the activities here. For me, most interesting is the acceleration of the development of new modules to monitor the implications of climate change. Of course, those new modules will need data. So we will see more exercises, I believe, in the EU on statistical data, which will feed those modules. And of course, this will affect the audience here. And already next year, we will see new climate stress tests being conducted by the ECB. And I think that's going to be an interesting learning experience and learning journey for all parties involved, as we see that the methodology behind that will be improving over time. I'd like to talk about in the next slide the taxonomy a little bit, because I think the taxonomy is really at the core of what the EU is driving here. This will be used as a basis for directing capital flows to encourage investment in financial products that are deemed to be environmentally sustainable. This will probably also be determined to assess risks, environmental risks of certain assets, and maybe also form the basis of bank capital requirements that are linked to environmentally beneficial assets. And we will see the NFRD and CSRD really heavily relying on this taxonomy, and this will be the basis that I believe by 2023, all larger EU corporations, so basically everybody with more than 20 million euro balance sheet, will need to report how aligned their economic activities are with this taxonomy, how green these undertakings are. And that data then will be used by other market participants to determine the greenness of assets. This will also be then used to drive disclosure, and we will see a strengthening of the CSRD. Eventually, this taxonomy will probably be used to determine green asset ratios by banks and KPIs on several banking operations. Now, with this transition to a much more concrete and regulatory-driven definition of what green finance is, there are risks emerging, and I'd like to say a couple of words on the last slides regarding these risks. And the governor has already addressed the risks of greenwashing, but I do believe that probably, in my opinion, there we are. In my opinion, two things for me are the most worrying. We will see an increase in the cost of equity and debt for non-sustainable industries, and we will see financial losses for non-sustainable industries. And the question will be, how are these costs being spread? Who's bearing those costs? And how smooth and predictable the transition will be? And the second thing I'm worried about is that we see the EU very much at the forefront of setting standards at this point in time. And the question is, how big will differences be between different jurisdictions and labels and standards? And what this will mean for the overall capital allocation. We have already talked about arbitrage. And I'll be very much looking forward for the coming up discussion on those topics. Thank you very much for your attention.
Okay, thank you very much, Mr. Windmöller. You gave a very good overview of the issues at hand and what we can expect and what are the risks. And so therefore, I think that gives us a lot of material for the discussion if we have some time. I hope so. But now, in order to strengthen our plan, I asked Mr. Friedl, who is a professor of business administration and controlling at the Technical University of Munich, to talk about his work, which is climate stress testing in the banking sector, the impact of a carbon dioxide tax on firm valuations and credit risk. Please start, Mr. Friedl.
Yeah, thank you very much, Professor Franke, and thank you very much for having me. What I want to do is to report about a project that we did in collaboration with the Frankfurt Institute of Risk Management and Regulation on the topic of basically ESG risks and their impact on banks. And what we did is we basically tried to identify the consequences that climate risks have on credit portfolios based on a bottom-up approach, where we really went into firms at the firm level and basically made a simulation about increasing CO2 taxes and what this has on asset values and the consequences that this might have on probabilities of default. And maybe we start with the next slide, where I can be quite short. You see that the relevance of ESG, and particularly ecological risks in the financial sector, has never been higher as today, and I can only follow the three speakers before in basically emphasizing that. And maybe we directly go to the next slide, because I think what is now important is that you distinguish in particular two types of climate risks. And the first one being the physical risk, that is basically a consequence of the major physical events, the sudden extreme weather events and so forth that we have experienced in the current year and in the last year in an unprecedented way. You all know about the floods in Central Europe, the fires in the Mediterranean region, and all the other major events around the world. And this physical risks basically affects asset value simply because it might destroy asset values in economies. And at the same time, there is a entirely different type of risk, which is also climate related, which is called the transition risk, the transitory risk. And this transitory risk has to do with the transition that we experience right now to a low carbon economy. And that could be a tighter climate policy, higher CO2 prices, more changing consumer preferences, all these types of events. And that might lead to stranded assets, for example, that are based on in fossil fuels. And so both risks affect the economy, but in a different way. And these risks, while affecting the economy, have direct transmission channels to the financial systems. You see corporate asset devaluations that affect the financial system. You see lower corporate profitability and increased litigation, which also might affect the financial system. Lower residential property values and lower household wealth. And there is also a way back, if the financial system gets affected, there might be some contagion, market losses, credit tightening feeding back to the economy, and that could basically initiate a circle that would be at risk. And this is basically also one of the main reasons why the European Banking Authority, the European Central Bank, the European Commission basically have close eyes on these climate risks in particular, but in a more broader sense, the ESG risks or the SDG risks, as Bodo Windmüller just defined them. So let me then go to the next slide, and where I just want to show you two studies that try to quantify these two different types of risks. There are a lot of studies out there at the moment, but I just want to provide examples here. And one example is a study that has basically analyzed various publicly listed companies in Norway, where they found if the global CO2 price would increase to either 100 or even 200 US dollars per ton of CO2, then there might be a loss in asset values of the asset holders by 5 to 11%. So you see a direct impact of these increasing prices to asset values. And when it comes to physical risks, there had been analysis of the impact of flooding in Florida on a mortgage portfolio, and there they also find a serious impact of 0.5% baseline in portfolio loss rates, and there are even more severe second round effects. And if you compare that with the financial crisis losses, you see that these physical risks affect the portfolios quite significantly. So you really see it, and you see a lot of emerging publications from central banks regarding initial approaches and high-level results towards this climate stress testing. Let me go to the next slide, please. And let me just give you an idea of what we did in our study. We also assumed that the European Union will increase the carbon costs by using a carbon tax, and we estimate the impact on firm valuations of the Euro Stoxx 600 companies And we also run a stress test for a European bank. And what we did is we basically assumed assumed certain climate change scenarios. We defined a number of scenarios, combinations, and we in particular analyzed carbon taxes of 50 euro per ton of carbon dioxide and of 100 euro per ton of carbon dioxide. And we then translated that into concrete climate footprints of the respective companies and added this carbon emission costs. And we summarized the climate cost in the net present value of future carbon tax payments and integrated that in a financial performance model of these companies. We looked at the balance sheet of the firms. We evaluated the assets, the equity, and the debt, and we compiled new probabilities of default of these firms based on the Merton model. And we then also measured the impact on certain credit risk metrics. And on top of that, we also applied the devaluation shock of equity and debt for 2 further investment portfolios. And the results are striking. And if you look at the results, and I just give you a glimpse on that on the next slide, then you will see that that different industries are affected differently by these scenarios. In particular, travel and leisure, utilities, basic resources are particularly heavily affected. And you see that the heaviest scenario considerably increased the probabilities of default and hence considerably affected the credit portfolios of our bank. Several other industries have not been affected so far so much. What we basically see is that we need to basically have an approach that is clearly industry specific in order to basically get this risk into the books. So just doing, let's say, a climate risk factor would not help, and that is, I think, an important learning from that. We are not, I mean, there are certain assumptions behind the model, so the concrete results with respect to the magnitude can be discussed. But at the same time, I truly believe that this general conceptual model that we applied is quite important and a way towards a better risk understanding for many European banks in this area. And let me conclude by going to the next slide. So what we basically did is we simulated the impact of climate risk on credit risk, and we yield considerable decline in capital ratios for the European bank example that we applied. We have seen for asset management that the impact on 2 exemplary portfolios provided by partners of the Frankfurt Institute of Risk Management yields substantial portfolio losses for the equity-focused fund, rather lower impact on the mixed equity and debt fund due to less addressable share in the portfolio. We also found that more ESG-related regulation for reporting and risk management is expected, and we announced, and we see recent regulatory and supervisory publications, and therefore this is a call for action for also for us in academia, but also for banks to develop new tools and methods. And the heterogeneous ESG reporting landscape and also the limited data availability. I mean, we looked at 600 largest European firms, and if you look to firms that are smaller, then you basically there is a real need for data on this climate-related risk, and these are still hampering the ESG-related risk management. So more on that and more details on that can be obtained when we disclose the study next week during the Green Finance Forum in Frankfurt. Happy to meet you there as well, but I'm also happy to answer any questions that you might have, and I happily give back to Günter Franke.
Okay, thank you very much, Mr. Friedel. That was a very good overview of what we need to do in bank management in order to get a sustainable bank management. Now we have about 5-6 minutes time. You see, the interesting thing is now we have the first presentation on the definition of green finance, and we have a second paper on the valuation effects on credit risk. But so far we have basically no clear-cut management story, so which is, of course, the third step, and which poses huge challenges, as also mentioned by the governor, Mr. Makhlouf. Let me perhaps start with the first question. Now, given the very strong conflicts between climate goals and social goals, now, can we expect a taxonomy which depends on the solution of these conflicts, or do we expect a definition of green finance which is basically sustainable and independent of these political conflicts? So let me ask Mr. Windmüller first.
If I knew the answer to that question, Professor Franke, we can see that the EU taxonomy is evolving. So it started really with the Paris goals on reaching our climate neutrality and mitigating the risks. We see other environmental goals being included at this point in the taxonomy. I do believe it will be very difficult to square this taxonomy with other SDG goals too. So to my prognosis, I'd say that in parallel other taxonomies will evolve, but it remains out how then the dependencies and the interactions between these taxonomies will be managed.
Okay, one short remark. If there are other people watching our session, you can put a question on the chat. So please do that. So we are happy to present it given our strong time limits. Now, the next question I would like to raise is to Mr. Friedl. Now, if the taxonomy is not so clear, and if the goals for climate change all the time, some people talk about 1.5%, others about 2.5%, and so on. Now, what does that have on your estimation of stress test scenarios? Do you find that this uncertainty in the definition of what is green exacerbates your stress test results?
I mean, in the long run, I would be confident that we do not need these stress tests anymore, because we might have a worldwide CO2 price that basically reflects the costs, and then everything is basically is factored in. But the way there is basically what makes it difficult, and it is so. For our stress test, at least, we only we concentrated on this on a CO2 tax, and I think the levels that we assumed, the 50 euro and 100 euro, are not too high. I mean, given what was discussed today in politics, I would assume that we will see these prices in the near future. So the stress test cannot be. We rather need to. I would rather suggest to even further increase these prices, because I believe that politics might act more quicker than we think. So we have seen an incredible dynamics during the last year, and given that we'll get a new government in Germany as well, it could well be that this transitory process will accelerate, and what we see in the stress example that we presented might even be the lower bound of the risk that is on the table.
Let me ask both of our speakers. You see, the tax is just one market-based instrument for climate change, but we see much more regulatory approaches. Now, when do we have to shut down coal companies? When do we have to shut down nuclear companies? I think that is probably a much higher risk, and it needs to be included in stress testing. So how can we get these things in a reasonable manner into our management models?
So I think that first of all, there has to be a basis on an agreement on what is actually economic activities which should be deemed green. So far, the taxonomy has been really very much in the hands of experts, technical experts, and not so much political discussion has started. We can see now, especially with the example you raised, Mr. Franke, with nuclear power, we start to see a huge political discussion on the taxonomy. So there is this underlying basis on scientific evolution and what can we say about what makes sense and what does not make sense in order to move forward. And that will evolve and will be politically influenced. On the second side then is, what do we do? How strongly do we incentivize the pursuit of these economies, and how do we do that? Do we have subsidiaries for green assets which are based on these taxonomies? Do we penalize market participants whose green asset ratios are not high enough? And that's then a different step of the discussion. And I think those two things will be interacting going forward.
Okay, thank you. Maybe we have a word from Mr. Friedel as well.
Yeah, maybe a view inside the firms that we are talking about. I mean, what we see there is that they are extremely struggling with all these types of things at the moment. And what we know basically is that all the firms that were basically deciding on their larger investment decisions based on net present values are now struggling with the fact that the whole landscape has changed, and now they have roadmaps towards climate neutrality. They must look at their supply chains and the sustainability of their supply chains, and they do not basically have the tools at the moment to basically address these topics correctly within the firm. And I think it's so there must be some simultaneousness because between what is going on at the regulatory level and what is going on within the firms. And what I am worried about is that the firms are not changing quickly enough towards into that direction to basically have steering instruments to control their own investment decisions. That is lacking at the moment.
Okay, unfortunately, time is running out. Thank you very much for the presentations and for the discussion. And I have, unfortunately, to hand back the microphone because the next session is starting. So hope to see you at least as a participant in the next sessions as well. So I say goodbye to you and hope to see you soon again. Thank you very much.
Thank you. Good morning. Welcome, everyone. My name is Wilfried Paus. I'm by profession a risk modeler at Deutsche Bank, but here I'm in my capacity as the co-chair of the Firm Advisory Board, and I'm looking forward to a good discussion we have today on sustainable business and financing Europe's green and digital future as the second session of the year's SSM Round Table. I'm pleased to have 4 distinguished panelists with me to discuss the opportunities and the challenges of effectively implementing and enabling greener financing in Europe. So the first person on the panel is Miles O'Grady, who joins us from the Bank of Ireland. He'll provide us with view on opportunities that have established in green financing, but also give us a share on what his bank in particular has already progressed in this space. Then we have Cecilia Ronan from Citigroup, who will also point out not only the developments in her bank, but a particular point to the challenges we have. And subsequently, Sebastian De Brouwer from the European Banking Federation joins us from Brussels, and I'm sure he'll give us a bit of a political insight, but also across the bank overview. And finally, I'm happy to have Yannick Leinerdecker joining us from the Boston Consulting Group, who has done recent research and actually been to Glasgow, as I heard, and I'm sure he will also share his insights. I'm looking for good discussions, and of course, I'm very happy to receive any questions from the audience, which we can then further elaborate in the panel. Without much further ado, I'm very happy to hand over to Miles, who is the CFO of the Bank of Ireland, has been doing this since 2019 and has a very distinguished career in the financial industry with at multiple institutions. So clearly a senior expert in this group. And Miles, the floor is yours.
Thank you, Wilfried, for that kind introduction. Good morning, everyone. Greetings, I have to say, from a notably mild weather day in Dublin today. And thank you also for inviting me today. Now, climate change and environmental degradation are clearly an existential threat to our world. We all have our part to play, including the availability of sustainable finance. And today I'd like to discuss Bank of Ireland's role in that regard. To frame the discussion, on slide 2, I've set out an outline of the external landscape. Let me highlight some of the key developments. COP26 still underway has focused the mind of policymakers with strong commitments emerging, such as pledges to end deforestation, reduce methane emissions, and the phasing out of coal-fired power. Ireland's own climate action plan now has a target to further cut carbon emissions and reach a target of 51% reduction by 2030. Rating agencies are helping investors to understand ESG risks. Recognizing the increase in demand for ESG analytics, many rating agencies are looking to invest. As an example, Moody's recently agreed to buy RMS, catastrophe risk management and modeling firm. And of course, changes in regulation continue at pace with a focus across the full range of environmental, social, and governance issues. Moving to slide 3, investors are incorporating ESG into their portfolios. In Europe, ESG funds now represent around 28% of the total assets under management, up from 22% in 2018. So we can see that trend emerging. ESG selection methods are seen across both active and passive funds. In active, we see investors chase themes such as water and clean energy, and there's a noticeable shift in appetite, particularly on the buy side, for actionable information on ESG metrics. Passive investors are also opting for funds with exclusion criteria such as tobacco and fossil fuels. The importance of ESG to both equity and debt markets can be seen on slide 4. On the left-hand side, we see that ESG indices are outperforming the broader market, with a mega trend towards a decarbonized future and a more sustainable economic model becoming clear. And the ESG imprint on the market is not only felt in equities. On the right-hand side of the slide, you can see that green bond issuances attract very significant investor demand, regularly pushing new issue premiums for new green bonds below what was the alternative non-green bond issuances. So put plainly, green financing makes economic as well as environmental sense. Turning now to slide 5, in Bank of Ireland, we've been working on environmental and social issues with the focus increasing significantly, like many companies in recent years. We stepped up our efforts to put in place a more coordinated and ambitious strategy across key environmental, social, and governance issues. Strengthened commitment kicked off with the group signing up to the UN Principles for Responsible Banking, becoming a supporter of the Task Force on Climate-Related Financial Disclosures, and earlier this year, we launched our responsible and sustainable business strategy, which we titled Investing in Tomorrow. Through our strategy, we have confirmed targets across 3 core areas: enabling colleagues to thrive, enhancing customers' financial well-being, and supporting the green transition. Moving to slide 6, incentivizing customers while protecting our business is of key importance to the group. Striking the right balance between ESG risk management and support for our customers is our objective. We are already achieving against the strategy. Some examples: we continue to embed ESG and climate risk into our risk frameworks. We published an exclusion policy for our corporate business. We've achieved a 77% reduction in carbon emissions intensity, and that's based on the 2011 baseline. And we've issued green bonds and developed green product offerings. And we also provide social programs such as financial well-being, youth programs, and a vulnerable customer unit, which was of particular importance during the recent pandemic. But of course, there is much more to do, including expanding our ESG risk appetite, setting science-based targets on our portfolios, and continuing to broaden our product offering. In order to effectively support our customers and protect our business, we need to enhance our ESG capabilities. Slide 7 captures these elements. The first is knowledge building. Industry data points reflect the need for increased ESG skills in the finance sector. And in Bank of Ireland, we are building that internally. We're embedding that knowledge at board and ExCo level, and also incorporating ESG into our scorecards and performance objectives. Data, crucial area of development. To inform and drive future decision-making, we have to develop a golden source data set. And lastly, it's about using this knowledge and data to make a positive impact. Sustainable finance offerings will embed ESG at the center of our product offering and customer engagements, while also protecting our business from the risk of stranded assets. Given the pace of change, by necessity, we have to be agile as we build these capabilities, and to an extent, we will be learning through doing. Continuing on this capability theme on slide 8, colleagues and customers. At Bank of Ireland, we are committed to becoming a digitally able learning organisation that values inclusion and diversity, reflecting society and our customer base. We also recognise the opportunities to enhance our customers' financial well-being and empower them to thrive financially, while also using enhanced technology and cybersecurity to help all our customers right through to the most vulnerable. And we understand the power in leveraging digital and data analytics to help support the transition to a resilient net zero economy by 2050. Moving to slide 9. In 2020, we launched our Green Bond Framework, the purpose of which is to fund sustainable financing and provide investors an opportunity to support us in our climate change ambitions. To date, we have issued 1.25 billion in green bonds. We are committed to being repeat issuers in this format, and our ambition is supported by a large green asset portfolio, which we expect to grow over time. The framework is aligned to the ICMA Green Bond principles, with lending to green buildings, renewable energy projects, and clean transportation. And we'll also provide investors with allocation and impact reports, which will be published in conjunction with our year-end results. Moving on to slide 10, and I guess in essence, bringing us back to the heart of my presentation, which is back to ESG investors and what are their requirements. They want to see alignment and compliance with the EU taxonomy. They want to see clear and realistic targets, and investors want to understand what makes up banks' loan books. Now, for a retail bank like Bank of Ireland, our minimal direct lending exposure to fossil fuels is seen as an important positive. Investors also want to understand the impact companies are making. We've implemented a material reduction in our carbon emissions intensity as part of our journey to making our own operations net zero by 2030. And also investors want to see external validation to provide reassurance. The slide shows Bank of Ireland's current standings in the eyes of external ESG rating agencies. And finally, to conclude on slide 11, Bank of Ireland will continue to execute our RSP strategy, enabling colleagues to thrive, enhancing financial well-being, and supporting the green transition. And on sustainability in particular, we have some key deliverables in the coming year that we've committed to, namely setting science-based targets, increasing the scale of sustainable financing as we work with key stakeholders such as the Irish government in delivering Ireland's 125 billion climate action plan. We're also committed to the further decarbonising our own operations and managing climate-related risks across our balance sheet. And of course, ensuring transparency in our reporting on our progress, and we'll see that with enhanced sustainability reporting in 2022. And so, in conclusion, ESG is becoming more and more important, not only to policymakers and regulators, but also to customers and investors. Bank of Ireland, we're committed to being part of the global drive for more responsible and business operations. And thank you very much for your time this morning.
Thank you, Miles, very much. Unfortunately, I think we missed showing your last slide here, but I think you well talked to the status in particular at the Bank of Ireland very well. Thank you very much. So next speaker, as I mentioned, a bit more sort of elaborating on the challenges that you face. And yes, it's great that we have a real CEO here, Cecilia Ronan from Citibank Europe, also acting as the country risk officer for Ireland and having a career in banking, but actually before that even worked sort of in another industry, as I understand from your early days. You were working for Microsoft. You basically seen more than just the industry that most of us have been working on. Cecilia, please.
Thank you very much, Wilfred. And Miles, I think that was very insightful, and there'll be definitely alignment between the indigenous banks and the international banks, I think, as I work through my presentation. I don't have slides because I want to actually make this quite practical, and the title is The Sustainable Banker. And in my view, sustainability is a step shift, and it's a new muscle for all of us over the coming years. It's going to be at the heart of our business models and indeed that of our clients. And fundamentals matter here because it will require active decision making, a little bit how Miles described Bank of Ireland have gone on their journey. If you look at ESG, essentially today it is leading with the E. It is front of mind of our clients, our investors, our shareholders, our employees, and our regulators. And Citi, as a global financial institution, we have both an opportunity and a responsibility to play a leading role in the transition to the net zero economy. Citi has committed to net zero carbon emissions by 2050, and these are emissions associated with our financing. and for our own operations by 2030. And I believe that this mirrors the aspiration for Europe to be the first climate neutral continent by 2050. We are also a founding signatory of the Net Zero Banking Alliance, and we've demonstrated our commitment to GFANZ at the recent COP26. How do we organize this transition? I believe it's got three priorities. Financing climate solutions in the first instance. We've committed to 500 billion financing for climate solutions by 2030. Measuring the reduction of climate risk and the impact of the client portfolios. And minimizing our own direct impact. I truly believe we all need to be risk managers in this green transition. And indeed, I heard Governor Makhlouf reference earlier, it is how we manage this change that will be key. Citibank Europe PLC is headquartered in Dublin, and we have 12,500 employees across 22 countries in the EU. Europe is at the forefront of ESG, and for Citi, globally, to meet its ambitions, we actually need to lead out of Europe, and Citibank Europe PLC will need to lead for Citi globally. Sustainability cannot be a separate layer in the organization. It needs to be embedded. And there are a number of actions that a sustainable banker needs to undertake. Firstly, we need to understand the financial needs and the choices of our clients as they move through this transition. This will be industry specific, sector by sector. And I know Yannick is going to reference some of the research that he did, particularly on sectors and portfolios. We do this with purpose. We have to understand the drivers and we have to adapt our product set and our advisory strategy, where ESG becomes essentially a service and a product. We will need expertise and talent. We will need to make strategic hires. That's at all the levels in the organization. Interestingly, I was just talking to the banking head and I was like, who do you need? And he said, I need data analysts. And I think that brings me to the next point. It is data and repositories, the ability to cut and cull and to report through public disclosures, and the culture where we have to adjust our scorecards, our key performance indicators, and indeed our reward structures to mirror this leadership. This does, though, bring me to the challenges, as Wilfred mentioned, that I would reference. And I also have an ask of regulators and policymakers. They're probably in three buckets. We cannot, and I repeat this, cannot achieve the goals of ESG without digitization, big data, data analytics. We will need to invest as an industry in technology and indeed in alternative or artificial intelligence tools. There will need to be data standards, especially for those of us who are subsidiaries of international banks and where our clients are indeed subs of corporate HQs. And this, I think, is particularly relevant for the financial and non-financial disclosures that we will be required to do, for example, the green asset ratio. Secondly, we will need to allocate funding and have funding structures in place to accelerate this. This may be public-private funding, but I truly believe that the completion and acceleration of the Capital Markets Union needs to provide diverse sources of funding for us. If you think back to Paris, when the first agreement was being negotiated, we realized that we need 260 billion additional investment a year to meet those 2030 targets. That cannot come from the banks alone. There needs to be the diverse funding sources. And the third thing that I would say is a consideration and a challenge is there has to be alignment and indeed linkages between regulators. The EU is ahead and we need to enable others to catch up. We are seeing globally the rise of country-specific taxonomies, and there needs to be cooperation internationally to ensure that global consistency. We do welcome last week's report on the international platform of sustainable finance as it spoke to ESG disclosures in particular. I just want to give some practical, I suppose, considerations for banks and indeed for sustainable bankers as we move through this. They're in 5 areas, and then I will come to my conclusion. Firstly, governance. Ownership by boards of climate risks affecting the firm and promoting a culture of focus on climate and ESG is absolutely key. understanding the impact of climate change on the risk profile, enhancing risk management frameworks so that you've got robust climate risk identification, measurement, monitoring, and mitigation. You have to look across all of the risk stripes, and we have to have a risk appetite in place around this. That brings me to the next point. Scenario analysis and stress testing is absolutely critical. We need to assess the impact of a future climate outcome on capital adequacy. Business model analysis, and I know Miles talked to this as well. What are the risks, but also what are the opportunities? This has to inform our strategic planning. And then finally, our disclosures. They need to be transparent. We cannot engage in greenwashing. Therefore, we need to look at our risk models and our valuation tools. We also need to communicate transparently our progress and our challenges. I don't think any of us think this is going to be easy. And so progress and reporting on that will be key alongside the disclosures. And so in conclusion, this is going to take a commitment. It's going to take a collective commitment that needs to lead to active decision-making and embeddedness of ESG. This collective commitment has to include the completion of the Capital Markets Union. We need to be aware and acknowledge the challenges that may impact the pace of change and the need for regulatory alignment. And then finally, data, data, data. The nomenclature, the standardization, and the investment. This will ultimately be the competitive play, and I believe will differentiate firms in the future. Thank you, Wilfred.
Thank you very much, Cecilia. It's very, very broad and very comprehensive coverage. So let's take a look at sort of maybe a bit more again from the political landscape, or maybe a confirmation how this is done in other banks. So I'm happy to hand over to Sebastian De Brouwer, who has been with the European Banking Federation, I think for 15 years, if I'm not mistaken, but has also worked before in both bank and insurance. So again, rather broad background. Sebastian, please.
Okay, thank you. I hope you can hear me well. Thank you for having me with you today. Yeah, I'll give you the, well, perhaps a bit more general overview of the main challenge we believe banks are facing indeed in those two very important transitions. I think we can go to the next slide. So yes, as it was already mentioned, I think banks would of course have a major role in, confronting the challenge we are facing today. Well, the first one being still the challenge of the recovery, as we are not yet fully out of the COVID-19 health crisis. But going further, or we also believe, of course, that this recovery should be a green one. So we need to help not only banks, but the economy in general to transition to a sustainable future. And the third challenge is, of course, the challenge of the digital revolution, where we need to ensure that the regulatory framework is indeed fit for purpose. So this twin transition, as we call it in Europe, is of course provokes structural change in the banking sector. Well, interestingly, of course, these transitions are interlinked and mutually reinforcing. Digitalization contributes to a more environmentally friendly production process, service provisions, lifestyle, while greening the economy requires more advanced technology and digital solutions to accompany those structural changes. Now we can go to the next slide. If I start with the digital transition or the digital revolution, of course, technology and innovation have always been part of financial services and banking, but we face now, of course, a very accelerated digitalization, which is of a very different scale. It's really a game changer. And we're digging a bit more into the challenge faced by banks. So next slide. As I mentioned, a very much a game changer. We face changing behaviors by consumers, of course, the emergence of new technologies, huge competition by new entrants, the fintechs, the big techs of the world, which cause, of course, also changes in business models and risk of disintermediation by banks. And this is not only for banks, it's of course for the corporate sector in general. So we believe Europe's need more to unlock the opportunities that digital markets can bring. If you look at today's battlefields for success, they are controlled by the access to the digital infrastructure, so the operating system, the device, the consumer gateways, the data, the markets. We see platforms moving into financial services where they have significant advantage through the access to large data sets, including, by the way, bank data, because as you know, the PSD2 has also forced banks to share their own data, or at least part of them. And they also benefit from a much more lighter regulatory touch. So we work, of course, at DVF on all those issues, trying to ensure that the regulatory framework is indeed adapted also to support, the deployment of digital strategy for the banks on an equal footings. And let's go to the next slide. Maybe quickly 5, I would say, main development or main key issues which are key for us. First of all is the related to data economy and open finance. We strongly believe that reciprocal access to data and data sharing, particularly across sector and different market participants, will be essential to ensure fair competition with big techs, fintechs, and other providers of financial services. So we plead also therefore having access to data from other market players and other sectors. Third, and it's linked to this, it's the very important issues of payments. Payments are crucial in the digital economy, and banks are determined to continue to be part of the payment landscape in Europe. So they have the relationship, the infrastructure, they are compliant. They're also the natural guardians of users' data. So we support the general goal of a European solution in payments that would enable indeed people and business to make reliable, secure instant payment. And there is an initiative which is very much in the press nowadays, that on the European Payment Initiative, which indeed can help us meeting that goal. Third is the resilience. Of course, the increasing demand for digital solution infrastructure at a massive scales highlight the need for an operationally resilient cybersecurity ecosystem, where all links in the chain are secure and where financial institutions can safely and under fair conditions use third-party providers to offer innovative solutions. We are also very much in favor of extending the scrutiny and the supervision on cyber to third-party providers. Four, and that's of course very key as well, is the digital currency. Central banks around the world, including the European Central Bank, are now exploring how and whether to launch central bank digital currencies. And of course, this could have a fundamental impact on the banking business and banking business models, but also financial stability. So we do believe that we need to be, as bank, directly involved in the discussion, not only on the design, but also on the need of such a currency, given the possible impact. And fifth, and I think that's also very important, and we welcome there a lot of regulatory initiative by the European Commission, we need to ensure level playing field with non-banks, such as fintechs and big techs. I think actually Europe needs to do more to support European players, including banks, and creating a space that would allow them to innovate on an equal footing. So those are our priorities in terms of digital banking. Now let's go to the green transition. So next slides. Of course, a very important strategic priority for us as well. A bank will be key. I think it was already mentioned, and not only in terms of financing the green and the greening of our economy, but also in the way they can help their client business to go beyond pure lending and to go to more sustainable lending and borrowing. And banks wish embrace sustainability in their business model, strategy, and decision-making process will, of course, be best positioned to guide customers through the transition. I think we have had two very good example evidence already in this panel. So Europe is leading the global effort in tackling climate change, and so are, I believe, European banks. So we are making progress, but there is still a lot to do. Next slide. I'll go quickly. Banks are, of course, very much affected or impacted already now. They face pressure from investors, from other stakeholders. You know, there are rising supervisory and regulatory expectations. I think you can hear or read that in almost every day in the press. Banks are reviewing their business models and also business decision to try really to reduce risk, and all this will of course have also huge impact on companies themselves. And maybe let me go there as well into a bit more detail. Next slides. Maybe we can go actually looking at the time to the last slide. I think that's the most important one. So next one. The next one, yeah. So what do we need? What are our priorities? First of all, and I think it was mentioned, we need clarity from the government. Of course, finance is crucial to meet those sustainability goals, but change in regulation must of course go hand in hand with legislative change and new industrial green policies for particular sectors. So governments need to give more clarity on how themselves they will meet the objective. Banks are part of the solution, but they should not be left alone. I think it's not realistic to ask banks to make this shift in the absence of major change in the incentives of the underlying economy. Banks should not be put in a position to be the primary enforcer of climate policy. We need greater political ambition to align the underlying economy incentives with the Paris Agreement, and that's of course very important because we see a tendency now to shift some kind of responsibilities to the financial sector. Secondly, we need to have a smooth, orderly and just transition, so that we need, of course, to green the brown sector while at the same time supporting the new green companies that are emerging or that works already. And that means two things. First, we must avoid that banks come under pressure to make a very quick exit from lending to sector which might be brown now, but which have a credible, clear plans to move to the green economy. We need a phase-in approach. And secondly, we must also look at fiscal or capital incentive to support green investment, as well as supporting tool for incentivizing investment in climate-friendly economic activity. Third, and I think it was mentioned by Cecilia, of course, we need to meet the data challenge. Data. It's one of the main challenge. It relates indeed to the availability of reliable, adequate, recent, accessible, and low-cost data. This will be a key factor for also adequate banks risk management, and they are actually the prerequisite for the development also of quantification and a forward-looking methodology. There are improvements at the European level with the taxonomy, with sustainable finance disclosure regulation, the SFDR. But those are primarily focusing on green assets. We need, of course, to look also at the transition, and also we need to look at SMEs, which are out of the scope of some of those initiatives, and that will be, of course, particularly demanding, especially in Europe, where we know that, of course, SMEs plays a very important or represent a very important market share of the economy. And last but not least, I think climate change is a global challenge that demands global cooperation. It's good, of course, for Europe to be on the forefront, but at the end, we'll need to converge to more, I would say, harmonized standards. Otherwise, we'll get fragmentation and will not most likely meet the objective that we want to achieve. I'll stop here, and of course, I'm very happy to answer any question afterwards. Hope I've not been too long.
Thank you very much, Sebastian. That was again a very good overview, in particular also focusing on what we expect from regulators. Yannick, you are next. You're from joining us from the Boston Consulting Group, and I think you do a bit more deep dive into sort of particularly the industries driving climate change and what the banks can do. So the floor is yours. Thanks. Please unmute yourself. Here we go.
Oh, yes, here we go. Perfect. Thanks, Wilfried, for this kind introduction. So yes, indeed, more than happy. And given your introduction, also what we've heard in the previous session, let me maybe focus on two aspects. One being indeed the climate transition and trying to put some figures behind that. And Wilfried, you indeed mentioned that Glasgow. So there may be some insights. Was just very interesting coming from a discussion, let's say, other areas outside Europe, looking on the European continent, what is happening there on the sustainable finance front. So I would like to share some insights from that. But starting off, and we can actually jump to the next page of the presentation. So we basically started off with a study in late 2020, together with the GFMA, the Global Financial Market Association, where we tried to basically put an actual dollar or euro figure behind the costs of the climate transition. And the approach we have taken for that, and I think there are some interesting insights for that, is obviously you start with looking at the global greenhouse gas emissions on a global basis. And interestingly, obviously, there are certain sectors which are, let's say, largely responsible, talking about coal, talking about the transportation sector, talking about agriculture, to name some of them. And obviously, the same logic can obviously be replicated by taking a perspective at the European Union. European Union, in general, you could say, accounts for about 8 to 10% of global greenhouse gas emissions, with a very similar distribution with regards to what are the most relevant sectors. And as part of this exercise, I'm happy to jump to the next page. We basically took an approach whereby we spoke with the different industry experts. So basically speaking with the cement industry, speaking with the energy industry, really to get a more granular understanding. What are the technical measures? What are the levers that need to be pulled in order to allow for the decarbonization of the respective industries? And then obviously from that approach, trying to put some sort of euro or dollar figure behind that. And interestingly so if you look at the sort of very very global figure. We talk about 120, 150 trillion dollar investment till 2050. And interesting, so a large part of this investment is very likely to be spent in the Asian area. So this is the whole discussion around the decarbonization of China and others. But at the same time, obviously, there is still a fair fraction of the pie that needs to be also spent within the European market. And just looking at the European figures, so I mentioned before, 8% of the greenhouse gas emissions coming from Europe. If you look at the estimates that we see from an investment side, we're actually talking about around 20, 21 trillion, which is basically around 17, 18%. And this is, I think, one of the interesting aspects. So even so, the transition in Europe might only account for, let's say, 8% of the greenhouse gas emissions. The investment effort as such is likely going to be higher, given the fact that we already have, let's say the easy wins, the quick wins have already been realized. And now we are talking about the more difficult levers that need to be implemented. Other countries, especially in the developing worlds, obviously have the, let's say, quick wins still ahead of them. So basically meaning for them, it can also mean that their climate transition is going to be cheaper. But what did we take out of this discussion? So coming from this sort of overall investment figure, this was only the starting point to then look at the financing side. So in terms of, okay, what are the different sources that can be leveraged? So basically looking at existing financing sources. Are we looking at the loan market? Are we looking at the bond or equity market? And based on that, and I guess, Sebastian, this also fits quite nicely into some of the remarks you've been giving earlier. You obviously enter into some type of debate of what to take from that. So just to share one insight here, the same study that we did on a global level, we have basically replicated for the Swiss economy with the Swiss Banking Association, and for them it was also quite insightful. So for them, the key insight, so they were talking about 12 billion franken on an annual basis as an on top investment, and they were quite heavily positioning this also to talk about, okay, what are the political circumstances that we need so that we can fulfill this requirement. And they also had this nice talk about the climate police, basically. So is it really the financial sector that is supposed to enforce the change? Or is it more a discussion around, okay, no, you as a legislator, you tell us what is allowed and we will provide the financing for that, but not so much if it's allowed, but maybe not good. Please do not force us to change the customer behavior. So this was sort of quite an interesting debate, which emerged out of this discussion. And I mean, Cecilia, coming back to what you now outlined, this was, from our perspective, I would say, an impulse to the industry. There is also a business opportunity, right? So there is a climate transition ahead of us. And yes, you might be sort of going out of brown investments, but at the same time, this might be compensated by transition financing. And this is certainly an opportunity that the financial services industry is very likely going to take. And I mean, just looking at the variety of announcements that we have seen over the past 1 to 2 years in terms of we will be net zero by this and this date, I think that's great. I think the interesting part is more when we talk about the actual operationalization. So when we talk about, let's say, the tough choices, stopping certain financing investment activities, but at the same time also, let's say, building the capabilities, because transition financing might in some instances be, let's say, slightly different to what you've been doing in the past. So this is my first impulse in terms of giving some sort of figure or perspective about the climate transition which is ahead of us. Let me now maybe quickly shift to 1 or 2 remarks on Glasgow. So I've been joining a discussion with within the Russian pavilion. So it was basically with representatives from Russian banks, from the Russian industry. And for them, basically now with the Russian government committing to a net zero part by 2060, now obviously the discussions start, okay, what do we need to do to make this happen? And especially for the financial sector, what are the incentives? How do we need to position ourselves? And obviously for them from the outside, looking at Europe is obviously a very interesting perspective. And I mean, Sebastian, you've been mentioning it a couple of times, Europe is ahead of the game. And I would totally agree on this one. And I think what was quite interesting were the sort of areas which are being looked at from the outside. So yes, data being one, and I think we had some interesting debate here around strengthened regulation, but also harmonization of reporting frameworks. So this was one of the key insights in terms of, yes, data is key. Currently, they are trying to basically also talk about alliances within their own financial sector. But I think the impulse, what they are looking for in Europe is really what is happening here with the additional reporting requirements on the one hand side, but also with the increased, or hopefully increased harmonization of the reporting requirements. Taxonomy being a second one. So yes, I think this is certainly a very, very interesting point. And as you've outlined, other countries have also started their journeys on the taxonomy, most of them usually in a less rigorous way, you could say. And I guess one of the interesting aspects for the discussion is always this differentiation between what is the green activity as opposed to what is the transitional activity. And I guess one of the sort of, let's say, points of debates which emerged from the discussion was really, do we get the credit to basically put money into the transition? Or is the taxonomy eventually too rigorous? And I think that's like one area which you could obviously debate, especially when we talk about the upcoming 20 to 30 year period. And last but not least, one of the key aspects to talk about were incentives. So what will really trigger the sort of adjusted flow of capital? And I think one of the interesting aspects here was also the ongoing discussion in Europe looking at the green asset ratios. So yes, at the moment, we are only talking about, let's say, transparency obligations, but obviously, this might obviously trigger follow-up discussions, right? In terms of, okay, once banks have started to publish, once the methodology comes more stringent, obviously you can imagine certain discussions to emerge. What is the sort of adequate level, investor pressure coming up, etc. So I think that was also one of the, let's say, interesting perspectives looking at Europe from the outside, where people are quite, let's say, interested to see how the developments in the European market are going to evolve. And with that, Wilfried, for the last 10 minutes, I guess giving it back to you.
Thank you very much. Again, very insightful. So I think given we have all made statements and you cross-reference them, are there any immediate statements you want to make to your fellow speakers here from anyone on the panel? If not, then I just let me start with a slightly provocative question, maybe to Cecilia. So, do you think a sustainable banker should trade bitcoins?
Yeah, that is very provocative. Financial services is, going through quite a transition itself at the moment, transformation and disintermediation as well. You've got cryptocurrencies, bitcoins, you've got CBDCs that are obviously coming on stream as well with various different governments and central banks. I think you have to be very careful on the guardrails that actually you put around the decisioning in respect to, this new currency, etc. So I wouldn't commit to that one, certainly at the moment. I don't think, I think we might be a fast follower, but certainly not a leader out there at this moment in time on crypto and Bitcoin.
Are there any other views on that? I think it's really tricky. Yeah, please.
I'd say it would. Well, I was just going to say it would be a breaker that leads out on endorsing cryptocurrencies right now. So I think that's Cecilia's message, that this is one to wait and see, I think, for quite some time. That would be my view for sure.
Miles, one question, sorry, my micro. And I think on your slides, which was a bit hard to read, I saw a good comparison in terms of that there are different levels of rigidity, how you actually value sort of green assets. Yeah, I mean that, I'm not talking not for my own institution, but obviously it has been all over the press that there's always a lot of pressure from, let's say, fund managers who are supposed to boost their ESG funds, that they then, this kind of greenwashing exercise is always the risk that this runs. How do you do this in your institution to make sure that that you have these relevant controls and that what you sell as green is really green?
Yeah, I mean, so one observation is I spend about 20% of my time as CFO meeting our investor base. So I meet about 40% of our investors at least 3 times a year. And I'd say over the last 3 years that question on ESG has kind of gone from being in the top 10 questions to being in the top 5, and at times getting into the top 3, right? So it's definitely up there. It's been really important. And we also know, and let's assume that we're not debating the moral basis for greening our economy, but we also know on a data basis that companies that really embed ESG outperform. And that's a compelling, for any CEO or any CFO, that's a compelling reason to put energy behind this. And so that's, aside from all of the good things about communities and customers, which are very important, but generating long-term sustainable returns for investors, ESG has to be at the heart of that. So there can't be greenwashing. I think a lot of us probably in previous years biased our activities towards more reporting in our annual reports rather than substance. I think we're all getting into the substance now. That'll be a very honest view, and we know the prize is there. And to answer your question, I mean, there are rules on this. So when you think about our green bond frameworks and the commitments we make to our investors, we say when we take your capital, we will put these into green bonds. Whether that's investing in green infrastructure, whether it's investing, putting capital into developers who wish to build green homes, whether that's offering attractive mortgage rates for customers who are willing to purchase energy efficient homes, retrofitting people's homes to be more energy efficient, or helping corporate customers transition to the green agenda. There's clear criteria. I think even the rating agencies are quite tough on this. There's nowhere really to hide, and I think that the analytics will demonstrate which companies are doing this in substance and which are greenwashing. But we certainly take it very seriously for all of the reasons that I've just said.
Oh, that makes perfect sense. Yeah, I've been. My question is coming from that. I've heard some recent talks about how actually external ratings are created, and there is still sort of there's always some gray area where it's very difficult to decide. And I think Yannick pointed that out as well, that to really decide what fits into the right bucket and what is more a transitional investment versus a real green investment and things like that. I think that's something we have to monitor, but I take your statement as that we have to be rather very rigid on these views rather than being sort of taking a soft view for the purpose of growing the business. I have Yannick, maybe on your point, you mentioned you gave us the outside view of the in particular the Russian perspective, but generally how people look at Europe, and maybe that's also to the others here. I've seen there has been a lot of development in the UK recently, and now with the UK sort of not being part of the European Union as well, is there anything you would call out that we should really also translate into the European Union, and in order not to sort of lose pace here? Maybe Sebastian or anybody who has an observation on that. You're on, everybody on mute. Yeah, there you go.
So is it for me? Is it for Yannick?
I think we lost Wilfried. I think Sebastian, first move was, I guess, in your direction, if I understood.
Yeah, that's right. Sorry. I'm
happy to let you go first.
No. Well, of course, we need to look at the UK market as well. Honestly speaking, I think we are generally aligned at European level, and even on many issues, even still ahead. Well, key is indeed to converge progressively. So that's the reason why we're also very happy, of course, that the issues are dealt with at international level. So notably by the G20, the FSB. No convergence. I think we spoke about the IFRS, for instance, initiative, which will be more, I guess, the foundation and Europe and other part of the world will most likely go further. So I think we have to accept that Europe is a front runner. It can also be an opportunity for us, for many banks as well. But hopefully then Europe will be able to, well, also to make the rest of the world converging in its direction and not take another direction, because otherwise this will create even more fragmentation. So hopefully the leadership role of Europe will pay this time.
Thank you. Yannick, sorry, for confusion. Do you want to add anything?
And yeah, maybe just adding to just no worries, and just adding to this remark. I think, I mean, and I get
breaking up, unfortunately.
Really seeing the ISSP announcement and what it sort of.
Yeah, I guess so. So I'm sorry, Yannick, we've lost the connection, but I think time is flying. Thank you very much.
Right? But if you take like one step back in terms of, let's say, the heterogeneity of reporting frameworks, all of course, but then the internet will stay.
Okay, sorry, I was already starting my closing remark because we obviously have some connection problems. No, it's Yannick, fine. I was just asked to come to a close here in this panel. So sorry, we missed your last statements, but thank you very much to all panelists for their insights. I think it was a very broad and very interesting discussion. I understand that time is up, and the conference is now looking at the next session. So I'm very happy to hand over to the film board lead, Gerold Grashoff, to take up the next session, which is on upcoming regulation and in the post-pandemic era. So that's certainly a bit of a switch from green to Corona. Thank you very much again for everyone to join. And
thank you very much.
Bye.
Bye.
Yes, welcome everybody to the European SSM Round Table, the third session focusing on upcoming regulation in the post-pandemic era, a field that can have actually a very large impact on the performance of banks and the impact on society. My name is Gabriel Makhlouf. I'm the CEO of the Frankfurt-based Institute for Risk Management and Regulation, and it's my pleasure to welcome our three keynote speakers and panel participants. At Sibley, who is the Deputy Governor of Prudential Regulation of the Central Bank of Ireland in Dublin, Jakob Güntelberg, who is the Director of Risk Analysis at the EBA, the European Banking Authority in Paris, and Johann Huygen, who is the Chief Innovation Officer of Visor Software in Dublin. Welcome, everybody. So let me start with handing over for a short keynote speech to Ed Sibley, who will focus on the challenges and opportunities in the evolving regulatory environment post-COVID, so to say. So I'm handing over to you, Ed. My pleasure to welcome you to the panel.
So thanks very much, Gerald. It's a pleasure to be with you. So I'll in my kind of brief remarks, I'll reflect a little on the pace of change that we're going through and some of the drivers for change in the financial services sector, and the accompanying and necessary changes to financial regulation and supervision, which we'll need to address that change, all in the context of the continued aim for the financial system to sustainably serve the needs of the European economy, businesses, and citizens. So starting with change, so the drivers of change, I look at this in kind of three kind of broad buckets which do overlap. So firstly, thinking about from a technology perspective, very significant levels of technology change, in some ways accelerated by the pandemic, so increased dependency on technology, behavioral changes that we're seeing, disruption, significant disruption in certain sectors, including banking, with a fragmentation of the provision of services, the necessary internal disruption, so process re-engineering, offensive changes in terms of kind of building better capability, defensive changes in terms of mitigating risks such as cyber risks, and kind of overarching need to improve how we use data, how data is protected, and so on. So that's kind of number one. Secondly, climate, so kind of obviously connected with the theme of today, and we're a long way short of the necessary changes there, and I'll come back to that in a second. And thirdly, we've got kind of much more traditional business drivers, so cost agenda, potential further consolidation in the European banking market, and so on. So kind of a really significant level of change ahead of us, and change that we're in the midst of, with accompanying uncertainty. So then turning to kind of what do we need to think about from a regulatory and a supervisory perspective, well, I'll kind of capture that in five areas. So firstly, to think about refinement. So there's an enormous amount of work done post global financial crisis in terms of improving the regulatory framework. That continues to need to be refined and evolved, but in a much less kind of radical way. Clearly, the Basel III developments are important. I'll come back to that in a second. But also things such as the kind of safety nets and resolvability, and ultimately kind of things like banking union, are also important in this regard. But just to focus on Basel III for a moment, we can see the European Commission proposals that came out recently. They're very much welcomed, with the kind of aim of continuing to ensure that the banking system and the regulatory framework that underpin that are kind of suitably robust. I would emphasize that the pandemic has very clearly shown the need for a resilient banking system to support economic activity in both good times and bad. But it's also shown how interconnected we are at a global level, and the benefits of having consistent global standards, which clearly Basel III aims to deliver. Second area is to come back to climate. I know Jakob will cover this in a bit more detail than I will, but I don't want to ignore it totally. We are beyond late. and we're beyond slow in terms of dealing with what is already a crisis and is only going to get worse. When you think about it from a political, societal, economic perspective, regulatory perspective as well, we all need to catch up. We all need to change. We all need to build resilience in the face of climate risk, and we all need to play our part in addressing and minimizing the effects that we're already experiencing. Particularly as it's a non-linear risk, so as it crystallizes, it will crystallize in a non-linear way. So kind of real shocks that we will experience. I think ultimately we'll be too slow. We're too slow, so that means we're going to have a harder transition. And we also have kind of other risks in there, including geopolitical and reputational. So all that will have, I think, an increasingly biting effect on business, on lending, on investment, on risk management. Emphasizes the need for resilience, and also again emphasizes the need for good data to really understand what those risks are and how best to manage them. I've touched on technology already. It's kind of a third area. Clearly see from the European Commission digital finance strategy that embracing digital finance is a kind of key objective at a European level. The regulatory focus is also important, both in terms of kind of from a facilitation perspective, but also kind of really importantly in terms of maintaining trust in the financial system, and that the financial system continues to deliver what the European economy needs, what the European citizens need. Kind of a few key highlights in there. So we've got the Digital Operational Resilience Act, DORA, which I think really importantly recognises the importance of operational resilience, but also recognises the dependency from the financial system into the non-financial system. We can see big developments in terms of crypto assets and digital currencies. So MiCA is an important step forward in terms of the kind of regulation there. But I think we're only in the foothills there if we think about the kind of implications of digital currencies, including potentially central bank digital currencies, that will have far-reaching implications. We've seen a lot of work done and a lot of innovation in the payments area, so payments and e-money institutions. I think we're in catch-up mode a little bit on the regulatory side, so there is a framework there, but I think there's kind of a degree of inconsistency in terms of how we're looking at that across Europe. So that's definitely a drive. And perhaps the most important right now in this area is around anti-money laundering and counter-terrorism financing, and what's been demonstrated over the last number of years is inadequacies in this area. And I think we will have a kind of game-changing approach to dealing with AML, CTF over the coming years, which will cut across all sectors. The kind of primary importance in terms of this work is about maintaining safeguarding, maintaining trust, and sustainable delivery for what Europe needs. The third area I wanted to touch on is around accountability and culture. Some of this is kind of regulatory, some of it would be more supervisory, but certainly from kind of an Irish perspective, we've seen that having kind of better documented, clearer, more robust approach to decision making, the kind of clarity of how individual accountability interacts with collective accountability, how important that is in terms of improving governance, improving risk management, reducing the risk of failure. And we're certainly legislating for this in Ireland, and I'd expect there's going to be more developments at a European level in this area. And I think it's even more important when one considers the technology change and how the increasing dependency on technology to deliver outcomes for consumers to help in terms of make the kind of risk-based decisions in terms of kind of assessing capital and so on. So the use of data, modeling, ultimately AI, having clear accountability, having clear understanding of how those decisions are being made is really important in that context. And then finally, I just wanted to touch on supervision, so differentiating between regulation and supervision. Clearly, from a supervisory perspective, we work to the regulatory framework, but I think we can be more agile when we think about supervision. We can more quickly follow the risk So whether we're thinking about climate, operational resilience, technology change, business change, we work within the regulatory framework, but having a kind of clear understanding and following the risks, I think, is really important. I think we'll continue to do that from a supervisory perspective. But it's also, I think, and Joanne probably, I'm sure, will talk more about this, supervision itself needs to change in terms of moving to kind of more intelligent decision making, requiring better data, better use of that data, better use of technology, and so on. So I'll finish there. I think we're more mid-pandemic than end of pandemic. I think we also have a looming climate crisis. We have a huge amount of uncertainty from technology change, all with quite a lot of market exuberance in certain areas, so kind of a bit of froth in the markets as well. So we've got a kind of very important juxtaposition or kind of inflection point, I think, and that when we think about what's going to happen in the future, what's going to happen from a regulation perspective, more importantly, what's going to happen from a business and economic perspective, I think we need to kind of bear in mind where we are at. And thinking about that uncertainty, I think we all need to be forward-looking. We all need to kind of consider what we think is long-term, what is sustainable over the long term. And whatever that is, we need to underpin it with thinking about resilience in the face of uncertainty, agility to deal with that uncertainty, and a degree of humility, because it's absolutely certain that not all the assumptions that we're relying on today will hold over time. I hope that's helpful. Thanks very much for your attention. I look forward to hearing from Joanne and Jakob.
Yeah, thank you, Ed. That was great and a very comprehensive overview of the thinking and the upcoming regulation. I would like to ask one question regarding especially the technology change and disruption we are seeing. You elaborated a bit on that the value chain of banks are also more breaking up these days, especially in the payment sector, where we see a lot of new players, but also big players entering that field. And my question would be, especially in the context of the pandemic, I think one could argue that banks played a very important and successful role in actually helping society exactly on the interface of the financial, non-financial world by effectively paying out the loans and the support that was highly needed. One thing that always comes up in the discussion with bankers is, of course, how do we ensure a level playing field with the new entrants? So do you see in principle and specifically that payment providers, new entrants to the field of the banking world should be on the same level playing field as banks regarding regulation, especially AML and so on? What's your view on that?
So I certainly think that similar activity should be subject to similar levels of regulation or similar approach, certainly from when one thinks about outcomes. So, and I think AML is a good example of where I would expect to see a good amount of consistency. But ultimately, one needs to think about what the risks are. So there are different risks associated with a bank than with a payment or e-money institution. And so the regulatory approach needs to kind of address those risks. So maybe there are similar risks from an AML perspective, or certainly there's a kind of a good deal of overlap. So when one thinks about AML, one should be thinking about it in the same way. There isn't the same level, I mean, of credit exposure certainly taken by the payment institutions. You would hope not. And so maybe there kind of is a different approach there. For me, key thing for the payment institutions, e-money institutions, safeguarding the funds that they are holding, and because they're not subject to the same level of kind of protection from a depositor protection perspective, and the operational resilience, the continuity of service. Those things are relevant when one thinks about banks, but they're got out in a slightly different way. So it's we're similar kind of activity, same regulation, or certainly very kind of similar outcomes, where it's different activity or different risks, and I think it's appropriate for it to be a little different. Overall, I think we need to be thinking about the functioning of the system as a whole, and the services that the economy needs, the services that people in Europe need. And there is a degree of fragmentation there, but we need to focus on making sure that kind of overall the system works. Within that, there's pressure on banks to innovate and to recognize that they are under pressure, both at a kind of individual level, but also in terms of sectoral disruption.
Thank you very much. With that, I would like to hand over to Jacob, who will elaborate on integrating ESG risks that we already touched a bit on with into the prudential regulation of banks, and what's the view of the European Banking Authority, EBA, in Paris on that. Jacob, hand over to you.
Thank you, Gerald. Thanks, Ed. I can only echo Ed in saying, look, I think broadly speaking, regulation and supervisory practice needs to keep up with the world, right? Which is essentially the message. And I think we, in this area, this is exactly what's going on. So I think the view here is we need to, even as we're finalizing the implementation of Basel III, which to some extent is it's taken a decade, right? It was finalized back in 11-12, and the final implementation will be done in 2030, right? By now, if you look at it in timelines, right? So this also just makes a flag that although it sounds like there's massive movement and everything is happening in a rush, I would just remind people that normally banking regulation is done quite meticulously and carefully to try and map it out so that it doesn't blow up the system when it's trying to keep it safe, right? Just as a general observation of banking regulation. The other thing I would say is, look, what are we doing when it comes to ESG risks? And I think focus has been here mostly on climate change in the political debate and in the concern space. So what we're doing is we're working, I would say, on a, let's call it an evolutionary effort to upgrade pretty much the entire regulatory toolbox to make it more suited for this challenge. So what we're doing is we're doing a number of things, and many of these things, at least from the organization where I sit today, is based on political asks and worksheets being handed to us from the European Commission, right? At the same time, we're also working with international counterparts, namely the people in Basel at the BIS and other regulatory bodies around the world. So there is an acknowledgement that climate and ESG aspects are global issues. They're not just European, right? We can't build a carbon wall around Europe, to put it like that. So I think here what we're doing is we're looking at, first of all, we're looking at all of the pillars in the prudential regulatory framework. So what does that mean? That means we've been looking at how to upgrade and enhance the disclosures aspect for banks, and by implication, the customers of banks, right? This brings us to the data point that Ed mentioned, right? Here, we recognize that this is hard when you start, but without anybody asking for it, no work will ever be done and no investments will ever be made to make that data and start collecting that information. So that's the first effort that we've been doing, is to upgrade the disclosure requirements. That's a pillar 3 thing. I would say for those of you who are following this area, there's more to come. So be ready, right? This will happen in 2022, will become a requirement in 2022, but there's more to come. What's been left out from the disclosure requirements is we haven't asked for anything on SMEs yet, but I'd be very surprised if that is not somehow in the cards down the line, right? So pretty much enhancing disclosures to facilitate, I think, regulatory insight, but also client insight and investor insight into what's happening in the banking world in terms of these risk drivers. Second, we've begun looking more closely at risk management practices in banks. So we've issued, I think, a report mid-2021. What you should expect there is that there will be follow-up work to that report, and there will be some technical standards coming in 2022. So that means there will be more push on the banks as to how they manage their risks to make sure they include climate change related risk aspects, but also the broader palette of social and governance related risk aspects. Again, you can hear clear echoes of what Ed said in the beginning, right? That it's not that it's all about the environment, because there is clearly a link between some of the social dimensions of risk and what's done on the climate side. And governance is also an important aspect of managing your risk and running a good shop as a bank. So expect more on what is essentially a pillar two effort in the prudential framework. There's more coming on that space. Then we've also begun, and I say here carefully begun, we're looking at the core, if you will, of the capital requirements set of regulation. Here, there's been debates in the Basel Committee, but there's also debates within Europe amongst European both supervisors and regulators on this. So what will happen here is we expect to produce a discussion paper that we will send out in the spring next year, where we will ask for input on key aspects on where one could consider upgrading and modifying the capital requirements set out for banks. Here, I would say, again, you will hear that I'm violently agreeing with Ed. What we're saying is that this has to be based on risk. It has to be risk-based. It has to have the view that you consider the facts, right? Now, the challenge, of course, is that the facts, such as they are always backward-looking. So at the heart of the current banking regulation is a little bit of a tendency to say, look, the past is a good guide to what will happen going forward. For climate change, I think the challenge is that we know that the past is not a good guide for what's going to happen going forward. So one of the main challenges that we see is how do we get the whole long-run forward-looking nature of risks built into the prudential setup for banks. That also applies, by the way, to the Pillar 3 and the Pillar 2 things that I just talked about, right? And again, here, that also applies to supervisory practices. How do I provide guidelines and, if you will, instructions or templates or whatever word one prefers? How do I get that done in a way that updates the regulation, but at the same time updates supervisory practices to include looking at these aspects? And I would say that's probably the main challenge. I mean, the other main challenge is without data, how do you make it fact-based, right? So we're facing a challenge here, and I think the notion here is how do we best do that, and that's, I think, one of the big questions that we have to answer. I agree with Ed that the answer is not to wait and see, right? Because if we wait and see, we're going to have to wait 30 years before we have the evidence, and then it's probably a little bit too late, no? So I think here we're going to have some pragmatism, but also some careful choices need to be made to build a framework that will stand the test of time, and that's such that when the facts are in, the framework will be, so to speak, self-correcting and self-updating, right? That, I think, is a core challenge. Now, what else are we doing? We're also looking at other parts of the regulatory toolbox. So here, what do I mean by that? I mean, typically we've had standard setting, there's taxonomy choices, there's the language we use to talk about, say, financial instruments and risks. So there's a taxonomy and a standard setting task that needs to happen. Here, as you know, there's been work done by the European Commission. I think without saying too much, clearly EBA contributed to some of that work, right? So there's a taxonomy from the European Commission. Here, I would say the work continues, I think, to let's call it implement and refine, to use Ed's language. On that front, that will also continue to happen. There will also be, and there has been already, a debate about how do I label financial instruments? What am I allowed to call a green something? Green securitization, green bond, green mortgage, green consumer loans, green car loans. What is green and what is not green? So here, the notion, of course, is that from a regulatory perspective, we'd like to help make sure that when people call something, that it's reasonably honest, so we don't have a backlash and that the green label becomes, let's call it, tarnished and ill repute, so that we don't build up a financial system that has a language and a taxonomy and an approach that allows investors and participants in the financial system and in financial markets to distinguish in a good way, right? So this is, you can view it as, we're trying to protect the system, we're trying to protect investors, we're trying to protect people against their own bad instincts here, right? So this is another area of work where we are involved. And I think, again, the European Commission is asking for input and advice on this. We are contributing, as are others. I know there are industry views as well. I think that's super helpful, because one of the concerns I have is that if we move too quickly, and if we don't allow industry to take on this task, which I fundamentally think would be best dealt with by responsible industry efforts, I think we risk pouring 2021 concrete on the language used by the financial industry, and I'm not sure that's a help in terms of getting the right language and the right discipline, right? So, but this is, so there's another area where we're working, and there's a balancing act, right? We would like green financial markets to flourish, to help finance the transition. The same for banks. We'd like this to work within the banking industry, because ultimately what we're hoping to do here is to make the banking industry and the financial system be able to finance the transition to a more sustainable economy, right? That's the objective. So the labels and taxonomy debate we're having is all to that end. Finally, and this is the last thing I'm going to cover quickly, is stress testing. So what we've done as part of the regulatory toolbox is that we've been stress testing and running, if you will, fictitious war games for the financial industry to assess its robustness and ability to deliver the financing and the transformation of savings into investments in the economy, right? So here, obviously, we are going to work also on climate stress testing, introducing longer run risk drivers to see what, to what extent is the financial industry well placed? What is the risk base for the financial industry? And I mean, when I say financial industry, I mean everybody, right? So we're going to try and do systemic stress testing, but we're also going to look specifically at banks where I sit, right? So we're working together with the rest of the European and national authorities on this to continue to analyze and assess, but quite frankly also to nudge the data collection and the infrastructure build up in terms of risk assessment capacity in the banking industry. Yeah, and we know, I'm just going to say that when I know somebody's going to say that when there are questions in these things, right? We understand that when we nudge banks and we put requirements on them, we are pushing indirectly bank clients as well, right? I think that's important. One of the areas where we are obviously concerned about is, what does the total risk sharing look like? Who's actually holding the risks from environmental change or climate change? Does it really sit on bank balance sheets? Does it sit with insurance companies? How much is actually borne by future taxpayers? And how much sits with individual companies and households themselves, right? So a key challenge there is that understanding of where are the risks, who's actually going to bear the brunt of these changes that we've been told are going to happen, right? But that's the last thing of the regulatory toolbox that we are busily working away at back at the regulatory lab, if I can use that term. Yeah. Anyway, thank you. Yeah.
Great, Jacob. Thank you very much for that thoughtful overview of how ESG and ESG risks can actually mitigate it in the future by the prudential regulation approach. I would focus on one question regarding the role banks need to play. And I'm actually personally a bit excited about also the role the financial system needs to play, because historically it's always been at the center of the economy, connecting many businesses with the investment world. and therefore playing a big change agent role. Yeah, and I said that before. I think it was also for the society and the banking sector or financial sector as a whole very important to show under COVID that this can be a very positive role and very much contributing to society. With regard to ESG, you mentioned that the ultimate goal is, of course, to finance the transmission to a green or greener economy. That is obviously enabled by transition of savings also into the investment world. What do you think is the biggest obstacle today, and how can we overcome it to actually enable banks to play that role in the ESG context? Yeah, given that you mentioned it's a huge challenge on the data side. If we are not really sure yet what the taxonomy, the standards look like, the data still need to be captured. It's a bit hard to imagine how you can play a change agent role. What's your view on that?
Thank you. So partial answer, right? I think banks have banks have two roles, right? I think one is that they need to upgrade themselves. So I think one of the challenges is that historically, I think the lending process and the credit generation process by banks has been focused very much on financials and a little bit on management quality, right? So it's very, very, very clear to me that banks are also have to upgrade their lending approaches. They have to upgrade their entire loan origination process, and that's a big task, right? I want to, and I think banks are aware. I don't want to sound as if they don't know, because they totally are aware and think they are busily working on that. But I want to make clear that I think it has to be understood that is a big investment that needs to be made by banks. That's not just something you just turn on the light in room 3 and everybody's happy, right? This is it's a big system change. There's also, I think, a cultural component. But I think the banks are on this, right? They're doing it, but this is a challenge. Now, part of this also means that they will be busy looking inward in certain ways, right? Now, I think at the same time, the other important role banks have to play, they need to advise their clients. So they need to build up the competence and the skills so that when they originate loan and they provide financial advice, that these new aspects, these new risk considerations, get to become part and parcel of how you give advice. So I think here, again, and I'm sure that banks have been doing that already, but I think making it a more comprehensive, holistic thing, and not just something you do for the oil industry and for agriculture, but for everyone you talk to, I think is a little bit of an investment that needs to be made by banks. But then I also think bank clients need to get used to the fact, they will have to get used to the fact that the banks will be asking the question, right? They will be saying, excuse me, your business plan says nothing about the energy efficiency. It says nothing about the pollutants you put out. And we will be asking our own critical questions because we will have to take a view on this from a risk perspective. And I think that way of that dialogue and that interaction, while existing and being, I think, very well and alive, I think that will have to morph or change or evolve into including more dimensions. And I think that dialogue, and that includes the data aspect, right? That in part means that then bank clients will have to invest in getting a handle on how their business affects the environment. What are the risks for that business given the coming climate change, right? Also for households. Where is my house placed? Is there flood risk? Is there avalanche risk? Is there fire risk? I think, again, here that the banks, and when they give mortgages, when they give car loans, that dialogue will have to change. I think it is changing, but I'm just saying it's not something you just do overnight, right? It's a lot of people, it's a lot of IT systems, and it's a lot of culture and tradition that has to somehow adapt, adjust, and overcome, to use some military language for once, right? But I mean, I think that I think is really the key thing that needs to happen. And I think when saying that, I can see my successor here in the speaking order nodding. I think there's definitely a technology component that can help, just to make that clear.
Thank you so much, Jacob. So with that, I would like to hand over to Johann Horgan, who is the Chief Innovation Officer of Basel Software Company. And Johann, please elaborate a bit on how you see the future of regulation, especially from a tech perspective between RegTech, SupTech, and the data challenge, and where we can improve efficiency and effectiveness, ideally. Over to you.
Thanks very much, and thanks Ed and Jacob. I have to say, after the two of you, I'm not sure how well I will speak on this topic of ESG, and regulation wouldn't be my strong point necessarily, even though I work in this area. I'm much more of a technologist. I would say, what I'm going to speak about today is just some of the areas where we see technology, and we're talking about RegTech and SupTech, where that can promote sustainability and assist in furthering ESG goals. And if we move on to the first slide, I guess one of the challenges that we see is, what does good look like? What does ESG mean? We're talking about data, and we talk about, we talk about the importance of ESG, but having gone through this recently in trying to incorporate ESG into part of our business strategy, there is no single definition of what that is. So there are lots and lots of different topics that come under environmental, for example. And if we look at CO2 emissions and the net zero goal, yes, there are technologies that can help. So we see that, for example, some of the cloud providers have very ambitious net zero targets. Google is carbon neutral today, but they hope to run on carbon-free energy by 2030. AWS, similar, they're looking at 2040, and Azure is similar. So we have technology, I think, providers today who are saying that they can help firms in maybe achieving or towards achieving something like net zero or reducing their CO2 emissions. So removing some of that maybe on-premise systems that they have, using cloud providers as an example. But I think, as I mentioned, in environmental, there's lots of other areas where technology and digitalization plays a part. Probably a little bit late to be talking paper-based processes, but I think COVID has probably eliminated a lot of those in one foul swoop. So we would have seen, as recently as a few years ago, still lots of paper-based processes in place in regulators and also in financial services companies. And obviously, digitalization and using workflow processes that are automated. You see things like DocuSign, for example, has revolutionized probably a lot of the legal sector and approvals that happen. And I think that's another area where technology can help, can help firms to demonstrate an improvement in terms of their waste management, energy efficiency, etc. On the social side, I think probably the impact of RegTech and SupTech is probably relatively nascent. That there's, obviously market conduct regulators are taking an increased interest in promoting diversity and inclusion. They continue to focus on product responsibility. We do see, for example, one of the FCA's ESG priorities is to enhance the transparency of listed companies and regulated firms' diversity and inclusion performance. So, I see that there will be an increased focus from regulators on, how firms are going to demonstrate that they are achieving their ESG goals. But I do see a problem there in the fact that it's still very subjective. There isn't really a standard way of talking about or demonstrating maybe your improvement in performance against ESG goals. So we're still very much at the, I would say, discussion phase in a lot of these areas. There's discussion papers that I mentioned that the FCA and Bank of England have published about, how can they increase the pace of change on diversity and inclusion in boards in banks, etc. Probably the biggest area where RegTech and SupTech today plays a part is in governance. And, some of the areas that Jacob referred to, We see new taxonomies and technology solutions emerging around SFDR, alongside existing solutions which are focusing on how they incorporate ESG risks more heavily into their risk management frameworks. I still see, having looked a little bit at SFDR, and again, I'm not an expert in this, but I still see a bit of an issue in how data is being asked for, and maybe the plans for how firms are going to be asked for this data, because it's still very template based. It still seems very subjective. And that makes it difficult, I think, both for firms to interpret what they need to supply, and also, to be able to compare apples with apples. So when you're looking at how a firm is responding to a bank, for example, how they're responding to their sustainability goals, or how they've incorporated ESG, it still seems like it's going to be quite difficult at the moment without a very clear data model, for example. That's I think Jacob made a good point. You don't want to put in something that is very rigid, but at the same time, leaving it too open, it probably doesn't give firms enough guidance on what they need to supply. I think also another important area that Ed mentioned is AML and that area. And I think that's an area that probably my view is that we're kind of failing on it. I don't think the amount of with the amount of money that's been spent in this area, I still feel that in Europe and in other jurisdictions, we work in about 25, 30 countries around the world. And while there has been a lot of focus on client onboarding and things like that, when it comes to a macro view of AML at a jurisdictional level, or even a more broader global level, it isn't possible at the moment really to have a big impact on catching fraud at source, because typically there isn't a way, and some of that's down to data privacy and GDPR and things like that, but typically today there isn't really a very easy way for data from across multiple banks or even across multiple jurisdictions to be compared and contrasted, so that you can have a real impact on this area. So I'm going to focus a little bit more probably on an area that I'm most familiar with, given that that's the area we work in, which is kind of regulatory reporting, and where I see maybe that we can have or we need a little bit of a change going forward. So if you just move on to the next slide. If we look at how regulatory reporting works today, we see a lot of duplication and inefficiency, which is kind of contrary to the goals of a sustainable financial system. So, typically regulatory data models, etc., they're defined by the maybe EU, and national competent authorities will have their own, depending on whether it's a directive or legislative requirements, they may have their own version of that. And those data models are published in a human readable format, sometimes as templates, maybe a machine readable format as well. And the financial institution is then pretty fully responsible for interpreting and transforming data from their various source systems into these multiple aggregated templates. And then they push that data to the regulator in XBRL or XL or XML, whatever the format may be. And some of the problems we see with this model, and this isn't, this could be prudential data, statistical data, ESG risk-related data in future, and any type of data. The interpretation is probably, one of the key challenges. Every financial institution is trying to interpret what they're being asked for. And while there are taxonomies, I still feel when we're doing taxonomies at a more aggregated level of data, there's still quite a large interpretation challenge for firms. We spoke about, there's a little bit of a mention of Basel III there. The time that it takes, regulatory change can take years to implement. Months, I don't think it takes months in anywhere I've seen, but years typically to implement. And the implementation cost then is very high. So the regulator is paying for something. They're paying to implement new data models and rules. And the financial institution is also paying, because they're doing that interpretation. They're hiring solution providers to help them source, transform, and implement those data. And typically then, the quality is still poor. So even after all of this money that's been spent, data quality still tends to be quite poor, I think, even with validation put in place. So if we look at maybe, potential for how things might work in future, and this is, if we move on to the next slide, just our view of maybe how we should be thinking about data And I think it's really a mind shift, like a change in mindset. So rather than thinking about, you know, once-off data requirements or templates that we need for a particular moment in time, taking that I guess that catchphrase, reduce, reuse, and recycle, which is something that we all know when we're thinking about recycling waste, for example. We know that the data volumes are actually getting bigger, so it's not necessarily about reducing the volume of data or the variety of data that's required, but can we look at reducing the amount of times that we need to go back and forth between the regulator and the firms looking for data and asking for particular data. So we do see, with the introduction of more granular input data models, and again, whether that's related to, you know, loans and deposits and transactions, or whether it's related to looking at collecting more granular data about ESG risks and so on. I think moving towards a more granular input data model that's closer to industry standards, that's closer to the standards that banks are operating at, will have the effect of reducing the amount of effort that goes in and the amount of times that the regulator needs to go back looking for data. Reusing, so again, we've seen this, we work with about 25 regulators, and we always see new regulatory requirements coming. We rarely see old ones being sunsetted, if you like. So, you know, we have seen systems where, you know, there's a regulatory requirement or regulatory template that may have been thought up, you know, maybe not 20 years, but 10, 15 years ago, and it's still being asked for. And new ones are added. So we're asking for more and more data, but we're not actually looking at, can we reuse data that we have, or can we just scrap that old template that was looking at aggregate data and replace with a more granular data model. And I think, you know, we're looking at a possible, you know, a possible future where, ideally, where you have regulatory systems achieving more continuous improvement. So if you think of how Tesla pushes out automatic updates to its cars, if the regulator takes more, I would say, responsibility for the transformation of the data, for asking it the right questions. You know, when you want to do stress testing, you're not necessarily having to go back to the banks and ask for new data, because you've got granular data that you can ask questions of in the way that you want. You know, in terms of how this is implemented, there's lots of possible solutions. You know, it could be more like a joint utility solution, co-funded or co-owned by regulators and FIs. Maybe each financial institution still takes responsibility for hosting all of the granular data, because again, there's massive data volumes here. You don't want the regulator to take on the job of the terabytes of data that every bank has. But making that data more accessible, maybe via API or other technologies that are out there today. And I think, you know, that's probably where, you know, where we see it going. I think where the technology is there today to do a lot of this. And I think what it needs probably is, you know, it needs probably a broader change in mindset for how we think about getting data and how we think about exchanging data between financial institutions and the regulator, and moving from this kind of siloed view of data and systems into something that's a little bit more integrated. So they're just my thoughts, and I'd be happy to have any questions from Gerald or Ed or Jacob.
Yeah, excellent. Thank you so much. My question would focus on how we could actually implement that, or what are the obstacles. So, or in other words, if we can be much more efficient in exchanging data here, and ultimately also much more effective in the quality of the decision making, because the data quality itself is not sufficient or not so great. My question would be, why is it not happening already?
I think why it's not happening already is probably down to a couple of things. So one is there is no mandate to do this. There's nobody saying, you know, this is what we must do. There is no. I don't think the case has been made to make a massive change like this. I think each individual jurisdiction is looking at this. Obviously in the EU there's a broader EU-wide view of this, but typically what we see across countries is each individual jurisdiction is grappling with this at the moment. They're looking at, yes, we want to collect more granular data. But I think probably the reason this hasn't happened to date is because there hasn't been a more global mandate to do this. So where we see, if we take an example in the tax space, much simpler data, obviously, but with the Common Reporting Standard and FATCA, for example, the G20 decided that there would be an initiative to try to reduce tax evasion and put in place a system with the OECD that's managed by the OECD, put in place a taxonomy, put in place the legislative frameworks for countries to be able to exchange data. And that was up and running within the space of a couple of years. And that's because it came from the very top, I would say. So one of the reasons it's not in place is because there is no maybe mandate to do that. And probably because, are we actually measuring? I know there has been a lot of work from a lot of people now looking at, the cost and the burden of regulatory reporting. But how do we actually measure that, and how do we actually prove that if we implement something, a new way of exchanging data, that it's going to have an impact? Because I would imagine one of the other challenges, obviously, is data privacy and security. So if you're talking about granular data, you would have to be very, very careful about any personally identifiable information. We have seen a similar model, maybe not fully like this, but we do see jurisdictions that have, they're collecting the full loan book, full deposits from banks. I would say smaller jurisdictions with a less developed or maybe less legacy in place find it easier to do this. They find it easier to leapfrog. I think in Europe, for example, we've got a massive legacy of systems in place in banks, and maybe a massive legacy of regulations and various data requirements, which probably hamper this a little bit as well.
Thank you. So then I would say it's time for a quick wrap up. I would thank you all very much. I think regulation is extremely important if we think about what is at stake and how banks need to be ready, or the financial system needs to be ready to play the role it's supposed to play. I think you had a lot for a comprehensive overview and giving us a feeling what is coming up and how regulation, so to say, keeps up with the society changes. And Jacob, thank you very much for the very thoughtful deep dive on ESG and how that big transformative challenge can actually be handled. And Joanna, thanks for your insight on how to step up data quality and effectiveness and efficiency, actually handling that. Thanks to all panelists. And with that, I will hand over back to the SSM roundtable session. Thanks a lot.
Thank you very much.
Thanks all.
Ladies and gentlemen, good afternoon. I hope you had a pleasant lunch break. And I'm delighted seeing you again to our session 4, Effective ESG-related Supervision. Climate-related and environmental risks, social risks, and governance risks, in short, ESG risks, are one keyword today. In this session, our focus lies on C&E risks, and its story takes a little bit longer. In April 2018, the EU financial regulators for the banking sector, the insurance sector, and the capital markets raised awareness for risks related to climate change and the transition to a lower carbon economy in their joint committee report and risks and vulnerabilities in the EU financial system. In May 2019, Frank Elderson, nowadays member of the executive board of the ECB and vice chairman of the supervisory board of the ECB and chair of the Central Banks and Supervisors Network for Greening the Financial System, pointed out, quote, "We need to ensure resilience to climate change risks." In November 2019, Andrea Enria noted, quote, "Climate change is one of the biggest challenges we face now, if not the biggest. But the role of banks, regulators, and supervisors is limited. Our job is to ensure safe and sound banks. So if climate change leads to particular risks for banks, we have a duty to take this into account. And if there should be a risk differential between green and brown assets, we will take this into account too. All else is beyond our mandate." In December 2019, EBA published its action plan on sustainable finance, outlining its approach and timeline for delivering mandates related to environmental, social, and governance factors. Nearly 1 year later, in November 2020, the ECB published its guide on climate-related and environmental risks for banks. And in May 2021, EBA published the results of the EU-wide pilot exercise on climate risks. And 1 month later, it published its report on management and supervision of ESG risks for credit institutions and investment firms. Only a few weeks ago, on the 18th of October 2021, ECB banking supervision informed all significant institutions on participation in the 2022 ECB climate risk stress test. And 1 day later, Frank Elderson concluded, with regard to C&E risks, the main risk is inaction. At the end of October 2021, the EU Commission published its Banking Package 2021, as I just mentioned it at the start of this roundtable this morning. This proposal shall strengthen banks' resilience and contributes to the transition to climate neutrality. Even more, it provides stronger tools for banking supervisors overviewing EU banks. I hope you share my view that these selected data underscore the very high level of commitment to all European banking regulators and supervisors. Climate-related and environmental risk supervision is emerging, and its implications for financial institutions are profound and far-reaching. Climate-related target setting with clear yardsticks and gathering the right metrics will become key. Climate-related risks are investment risks and economic risks. Therefore, bank-to-client engagement has to be intensified, as well as bank-to-supervisors engagement and vice versa. Wise bankers consider that managing ESG risks may be probably the biggest upheaval in banks since the introduction of rating procedures in corporate finance. This foresight needs to be reconciled with the most other important structural challenges, which are profitability and digitalization. Once again, ladies and gentlemen, a warm welcome to all of you in front of your screens and to our speaker. Our speaker means I would like to express my greatest regret that our speaker, Jasper Hanewood, had to cancel at very short notice due to illness. So I'm quite sure to speak for everyone when I wish him all the best and a full and speedy recovery. May I briefly introduce to you our speaker, Dr. Thomas Stettner. Thomas is head of division in the supervisory branch of the ECB. His team supervises French Global SIFIs and Commerzbank in Germany. Additionally, Thomas heads the country team for French banks. Before his time at the ECB, Thomas was working for Deutsche Bank in London. There, he held several managerial positions in legal and risk department. He started his career as head of legal in an asset management company in Munich. Thomas studied law in Munich, Saarbrücken, and London, and is admitted as Rechtsanwalt in Germany and solicitor in England and Wales. A warm welcome to you, Thomas. The floor is yours.
Thanks a lot, Lothar, and thanks for inviting me. As you said, I'm also sorry that the co-speaker is not attending, because it would have been a quite nice discussion, I think, from the supervisory side, seeing these points, but also the feedback a little bit from the industry side in this very new field. Yeah. So, but thanks for your kind introduction, for having me here today at the 14th SSM Round Table. It has been some time since I last spoke here. I think it was at one of your first roundtables that you organized directly at the start of the SSM. So I'm very happy that you re-invite me again this time around. My remarks today are about the integration of climate and environmental tasks into the work of supervisors. The first question here, I would say, is why do supervisors these days care about issues like climate change or environmental risks? And the reason is that supervisors should always be mindful of the circumstances in which they will pursue their tasks and fulfill their responsibilities in the years to come. As many of our societies have been gradually reopening over the past months after the corona pandemic, we are ever so often reminded of another ongoing global crisis. We have seen major flooding as well as extreme heat waves and wildfires across the globe. According to most scientists, each of these events is confirming that the climate and environmental crisis is already upon us. Confirmation that the associated consequences are materializing to an increasing extent. The recent analysis of the Intergovernmental Panel on Climate Change, which was also published this summer, adds to the existing overwhelming evidence that climate change is real, and conclusions emphasize the need for urgent actions. But this report also shows that the incidences of extreme weather events is set to increase over time. Even if we manage to limit global warming to only 1.5 degrees Celsius, the incidence of such events would increase less dramatically, but still by a massive 50 to 75%. And to my understanding, and I'm certainly not an expert in this area, but to my understanding, we are now approaching 2.7 degrees by the end of the century if we would continue in the way as we do it right now. So you can imagine that these events and incidences would decrease even more dramatically. A report by the UN's Climate Agency released in September suggests that global warming could even be higher based on the current commitments. All of this shows that more needs to be done by governments and for societies as a whole. This would also mean that we as a banking supervisor have to adapt to new circumstances and look closely at risks associated with it. To understand why and how all of this is of importance for supervisors like the ECB, it is useful to think about the economic consequences of the climate and environmental crisis. Typically, when thinking about climate change and environmental degradation, we distinguish between physical risks and transition risks. Physical risks refer to all risks resulting from the changing climate. More frequent extreme weather events and gradual changes in climate to environmental degradation, such as air, water and land pollution, water stress, biodiversity loss, and deforestation. For example, extreme weather events, which have been steadily increasing over recent decades, can harm borrowers' ability to repay their debts and thus make the loan portfolio of banks much riskier. These risks can be further heightened if extreme weather events also depreciate the value of the assets used as collateral in those loans. The second part is then transitional risks. These are risks associated with a transition to a low carbon and more environmentally sustainable economy. This adjustment would be triggered by legislation that will be adopted, such as carbon pricing or banning of carbon-intensive activities. In addition, the transition is supported by shifting consumer preferences towards goods and services that are more sustainable. These changes will have a significant impact on climate-sensitive economic sectors and the broader economy and the financial system, in particular in the case of an abrupt transition to a low-carbon economy. Whatever combination of physical and transition risks will materialize, the macroeconomic consequences and financial risks of the climate and environmental crisis will be profound. This is confirmed by an ECB occasional paper on climate change and monetary policy in the euro area that was published in September 2021 in the context of our monetary policy strategy review. These consequences place the need to act squarely within the traditional mandates of central banks and supervisors. Sharing this insight, many central banks and supervisors have joined forces in the Network for Greening the Financial System, NFGS. Then NGFS brings together around 100 central banks and supervisors from all continents, and it is committed to developing climate and environmental risk management in the financial sector, as well as to mobilizing mainstream finance to support the transition to a sustainable economy. In this context, the ECB has been systematically and consistently integrating climate considerations into the activities through which it carries out its tasks and fulfills its responsibilities. Let me outline some of the main steps that we have set and are currently taking, focusing on banking supervision, of course. So in November of 2020, ECB Banking Supervision published a guide on climate-related environmental risks. In that guide, we make clear that we expect banks to take a comprehensive and strategic and forward-looking approach to disclosing and managing all climate-related and environmental risks, which also include, for example, the risks of biodiversity loss and pollution. When we ask banks to conduct a self-assessment relating to the expectations we set out in that guide and to draw up action plans for how they intend to comply with them. This supervisory exercise has begun with, but will not be limited to, taking stock of banks' self-assessment. Second, we are now in the process of benchmarking the bank's self-assessments and action plans, and will then challenge them as part of our ongoing supervision. The preliminary results show that no bank has the full picture on climate risks yet. None of the banks under our supervision meet all the expectations. But the good news is that many pieces of the climate and environmental risk puzzle can already be found scattered across the banking union. Almost all banks have developed implementation plans, and many have started to progressively improve their practices. The progress that we have identified can be observed in banks from different countries with different business models and different asset volumes. This confirms that what we are asking of the banks can be done. We can probably also, I can give you a bit more insight later on in the Q&A session. The ECB will see to it that every bank is making expeditious progress in embedding climate and environmental risks into their institution by following up with supervisory requirements where needed. This supervisory exercise will also offer banks a strong incentive to bolster their ability to identify and quantify their exposures to climate and environmental risks and their tolerance of these risks. To give you a sense of the magnitude of this exercise, we are reviewing plans covering 24 trillion worth of banking assets. Third, next year we will conduct a full supervisory review of banks' practices for incorporating climate risks into their risk frameworks. Fourth, We are gradually rolling out a dedicated supervisory review and evaluation process, so a SREP methodology that will eventually influence banks' Pillar 2 capital requirements. It will be part of the existing methodology, so it will be adapted, but it will be will comply and integrate climate and environmental risk elements. Fifth, ECB banking supervision will conduct a supervisory stress test with a focus on climate-related risks for the banks under our supervision. This will be based on a pioneering methodology for quantifying the impact of physical and transition risks on European banks over the next 30 years. We shared the methodology for this exercise with the banks under our supervision and published it on our website. The outcome of our supervisory exercises next year will be of a qualitative nature. A possible impact, if any, will be indirect via the SREP scores on Pillar 2 requirements, and no bank-specific results will be published. But let me stress that it is unlikely that this in the years to come, we will stop here. This is not the end game for sure. In an analytical report published earlier this year by the Basel Committee on Banking Supervision, it was concluded that climate-related risks can be captured in risk categories that are already used by financial institutions. For example, credit risk, market risk, liquidity risk, and operational risk. The ECB treating climate and environmental risks as any other risk with a reflection in all relevant supervisory requirements would be in line with this conclusion. This is probably what we can expect. Gradually, we will start doing just that. 6, on the intersection between macro and micro levels, in September this year, we published the outcome of an ECB economy-wide stress test. Unlike the stress test that will be conducted next year, this was a top-down exercise relying on data, assumptions, and models developed by ECB staff. It was a granular exercise relying on counterparty-level climate and financial information collected for millions of companies to which euro area banks are exposed via loans and security holdings. To the best of our knowledge, this data collection is the most comprehensive set of backward and forward-looking climate and financial information available to a central bank. The results of the analysis show that the short-term costs of a climate transition pale in comparison to the costs of unfettered climate change in the medium to long term. The costs of a transition are always more than compensated by long-term benefits in terms of investing in sustainable technologies. By contrast, if policies on transitioning towards a greener economy are not introduced, physical risks become increasingly higher over time. It is thus of the utmost importance to transition early and gradually to mitigate the costs of both the green transition and the future impact of natural disasters. The results of this exercise show that the impacts of climate-related environmental risks on average will increase moderately until 2050 if climate change is not mitigated, and they are concentrated in some geographical areas. The impact on banks' expected losses is shown to be mostly driven by physical risks, and it is potentially severe over the next 30 years. I hope all of this gives you a bit of an idea how important this topic is for the ECB as banking supervisor. And I would now stop with this presentation and hand over back to you, Lothar. Thanks a lot.
So, Thomas, thanks a lot for your remarks and comments, and you pointed it's quite clear. So let's go in some details. As you just mentioned, the ECB banking supervision has asked banks in the beginning of this year of self-assess their positions with regard to climate-related and environmental risks relative to these supervisory expectations. And later on, you will have been benchmarking the responses, and you will, as you just mentioned it, publish the results soon. Would you be so kind and give us a little more insight into this process and share with us some initial common findings?
Thanks a lot for this. And before I go into the details of our findings, let me first of all explain where we are coming from in these tasks. Following the adoption of the Paris Agreement on Climate Change and the UN 2030 Agenda for Sustainable Development in 2015, governments are making strides to the transition to low carbon and more circular economies on a global scale. In Europe, the European Green Deal sets out the objective to make Europe the first climate neutral continent by 2050. The financial sector obviously has to play a key role in this respect. Here in the ECB, for the second year in a row, we have identified climate-related risks as a key driver or risk driver in the SSM risk map for the euro area banking system. The ECB is of the view that institutions should take a strategic, forward-looking and comprehensive approach to considering climate and environmental risks. Our guide on climate and environmental risks outlines the ECB's understanding of a safe and prudent management of climate-related and environmental risks under the current prudential framework. It describes how the ECB expects institutions to consider climate-related risks as drivers of existing categories of risks when formulating and implementing their business strategy, the governance and risk management frameworks. It further explains how the ECB expects institutions to become more transparent by enhancing their climate-related environmental disclosures. Moreover, it aims to enhance the industry's awareness of and preparedness for managing climate-related risks. The guide does not substitute, of course, any applicable law. It should be read in conjunction with other ECB guides, in particular the ECB Guide on Internal Capital Adequacy Assessment Process, or the ICAP guide. It's not binding for institutions, but rather it serves as a basis for our supervisory dialogue with the institution. And as part of such a dialogue, significant institutions have been asked by the JST, so the Joint Supervisory Teams, to inform the ECB of any existing divergences in their practice from the supervisory expectations described in the guide, and to inform the ECB of arrangements aimed at progressively addressing these expectations. To give you a bit of an idea of the areas in which we set our expectations, we differentiate between the following topics. So first of all, business models and strategy, where we ask banks to assess the impact of climate-related risks on the business environment in which they operate, to assess or include climate risks that impact the business environment into their strategy. The second part would be then governance and risk appetite, where we ask banks to include climate risk in their risk appetite framework. The risk management part, to assign responsibility for climate risk within the organization structure, or to incorporate climate risk as drivers of existing risk categories, so credit risk, market risk, etc. And then the fourth part is disclosure, where we ask them to report aggregate risk data that reflect their exposure to climate risk. You see, if you summarize the ECB approach, we ask banks to take a comprehensive and strategic and forward-looking approach to disclosing and managing all climate-related environmental risks. Banks conducted self-assessments on the basis of these expectations, as you said, and we benchmark their preparations to address these risks. And we will publish this report soon, but some of the highlights are, on the bright side, that banks have started reflecting climate and environmental risks in their current structures. So roughly half of them are adapting their governance arrangements accordingly. Some banks have developed comprehensive dashboards for assessing C&E risks when granting credit. Some are tightening their credit granting criteria, and others are measuring and disclosing the carbon emissions linked to their loan book. The gloomier side of things is that the banks themselves deem 90% of their practices to be only partially or not at all compliant with the ECB's expectations. Tellingly, the only banks that did not identify as being exposed to medium and long-term climate risks were those which did not conduct a materiality assessment. This is all the more problematic when our benchmarking shows that a majority of banks said they were exposed to medium and long-term C&E risks. We expected them to analyze how these risks can or will affect the different portfolios and products over the short, medium and long term, considering various scenarios. Given the nature of C&E risks, this forward-looking type of analysis should be elementary practice. But the vast majority have not done this analysis yet. Concrete and important management tools and practices are lacking in this area. When looking for actions that go beyond a mere screening of the business environment, we found that about half of the banks under our direct supervision have few or no concrete action plan to embed C&E risks into their business strategy. Only a quarter of the institutions have set key indicators to monitor and steer the performance of their different business lines, portfolios and products with regard to, for example, green loan origination or their exposure to high carbon sectors. And only a quarter of those extend these key performance indicators to more than 25% of their portfolio. No more than a fifth of the banks under our direct supervision have set a key risk indicator for C&E risks in their risk appetite statement, and only about a third of these have set a concrete limit on these indicators. There are also encouraging examples, of course. Many banks have started to proactively manage their transition risks and set goals for decarbonization, net zero emissions, or alignment. Notably, a dozen banks have started measuring and monitoring the alignment of their portfolios, defining indicators and considering how to align their strategy to the Paris Agreement while avoiding an excessive buildup of transition risks. They are no doubt making progress. If banks are not closing the gap with our supervisory expectations, we will step up our supervisory efforts, of course, correspondingly. But my bottom line today is having processes and procedures in place, assigning responsibilities, conducting risk analysis of various sorts. These are all means to an end. Banks' plans to align their practices with our expectations will ensure that they have adequate risk management capabilities to weather the storms. But these capabilities should be used more broadly. So I would stop with this and then would hand back to you, Lothar.
Thank you, Thomas. So you mentioned the forward-looking approach. In this direction goes my next question. Sound and proper management of climate-related environmental risks requires a large amount of reliable data. In many cases, these data are either not readily available or are stored somewhere. In addition, the bank's data repositories are designed for historical data, also due to regulatory purposes. In your view, how should a bank address these data gaps in a reasonable amount of time?
Thanks for the question. It's obviously first and foremost up to the bank to find the right means. But the data will be very important in this whole process because we don't want to do only a qualitative assessment, but ultimately there should be also a quantifiable impact being measured when it comes to portfolios. So, but what I can say is basically also as a help for banks, where we have addressed essentially the issue of data in publicly available documents, so you can get a bit better idea where to look for this. And the first one would be again our supervisory expectation that was published on our website. And expectation 6 is dealing with data. So institutions, and just read here, are expected to report aggregated risk data that reflect their exposures to climate-related risks with a view to enabling the management body to make informed decisions. So the ECB consequently expects institutions to integrate climate-related and environmental risks into their data reporting frameworks with a view to informing decision-making at management level. The ECB, though, acknowledges that metrics and tools are evolving and that currently data available in institutions are sometimes incomplete. Nevertheless, we expect reporting of climate-related risks to mature over time. Initially, when accurate and complete reporting is deemed unfeasible or premature, we expect institutions to assess their data needs in order to inform their strategy setting, risk management, to identify gaps compared with current data, and to devise plans to overcome these gaps and tackle any insufficiencies. As climate-related risks have distinctive characteristics, institutions are expected to consider adapting their IT systems to systematically collect and aggregate the necessary data in order to assess their exposures to these risks. While institutions are expected to incorporate the data taxonomy of these risks, it is also acknowledged that this may not be feasible owing to the current lack of common definitions, taxonomies and data gaps. In this case, institutions are expected to consider establishing reporting processes and procedures based on internal or external qualitative risk metrics to ensure that climate-related risks are adequately reported to the management body. The second part or second work stream in this regard is affected by the Network for Greening the Financial System, so NGFS, and they have been doing quite a bit in this regard, and they have set up a dedicated work stream called Work Stream on Bridging the Data Gaps. And in line with its mandate, the work of the work stream is structured according to the following three-phased approach. First, they try to identify data items needed by the financial sector, and this will also include central banks and supervisors for the purpose of climate-related risk analysis and the scaling up of green finance. Second point is to determine whether the data items are available, and if so, identify their data sources and limitations for accessing them. The third one is to provide guidance and recommendations on how to bridge the data gaps identified. So this is something you can also see on the website of the NGFS, where they published their respective report. And the findings of the interaction with stakeholders suggest that the largest data gaps exist for forward-looking data, as you mentioned, such as emission pathways and companies' transition targets, so including interim targets. Given the importance of forward-looking assessments of both physical and transition risks, the current reliance on mostly backward-looking data is unsatisfactory. Stakeholders reported that they need to understand the point-in-time performance of an exposure against a transition pathway, hence the need for firms to disclose their transition plans, as well as the impact of adaptation and mitigation measures on the evolution of the risks. To ensure the availability of reliable and comparable climate-related data, a mix of policy interventions is needed to catalyze process. And there are three building blocks which are probably paramount. First of all, a rapid convergence towards a common and consistent set of global disclosure standards. Second one, efforts towards a minimally accepted global taxonomy. And third, the development and transparent use of well-defined and decision-useful metrics, certification labels, and methodological standards. The NGFS notes that there is a substantial scope for financial institutions to better leverage already available data sources and approaches. Financial institutions can also make better use of proxies and estimates, as well as qualitative approaches, while they build up capacity to enhance their ability to process climate-related data. And the last point I would like to mention here is our supervisory stress test in 2022. This exercise will also give a good overview of available data, as the stress test is considered to be a joint learning exercise, so not only for the industry, but also for us as supervisors. And one of its main objectives is to enhance the capacity of both banks and supervisors to assess climate risk. In this context, the quality assurance process also serves to enhance the supervisory understanding of what climate-relevant data banks have available and the limitations when assessing climate-related risks, to identify best practices and to ensure that banks follow the instructions as set out in the methodology. And you can find this on the website of the ECB as well to get a better idea of this. But maybe you can also speak about the stress test a bit more detail later on. Thanks, Lothar.
Thanks, Thomas. You mentioned the global warming and the discussion about 1.5 degrees versus nowadays, let's say 2.7 degrees warming. So let me ask following question. Managing climate-related risks requires a long-term approach with certain scenarios. You just mentioned it a little bit. What scientific requirements must these scenarios meet, and who should be responsible for these scenarios? The Financial Stability Board, the network of the bankers, central bankers and supervisors, the EU Commission, the ECB itself, or in other words, are those climate-related scenarios organized on a global or European or, let's say, even a national basis?
Thanks. First, I think we need to have in place science-based European transition scenarios. So far, we have been advising banks to refer to the International Energy Agency's reference scenarios. But these are global scenarios and they do not reflect the ongoing developments within the European framework. Instead, banks can rely on the work already developed in this realm by the Network for Greening the Financial System, which has been designing scenarios to assess the potential future impacts of climate risks under different climate policy actions. These scenarios are already a de facto international standard for central banks and supervisory authorities when performing climate stress tests and scenario analysis. As suggested by the European Commission new sustainable finance strategy, the NGFS scenarios should be considered a starting point for testing the impact of Europe's specific transition plans, as well as guiding banks for setting their own targets. The Commission encourages EU environmental and financial authorities to work together to tailor the global NGFS scenarios to European policies in a science-based manner. Such scenarios would also speed up the development of more advanced supervisory tools for assessing the forward-looking alignment strategies contained in banks' transition plans. In addition, EU-wide scenarios would serve as a benchmark for the industry as a whole and thereby promote self-discipline among market participants. I would close with this.
Okay, thanks. So you mentioned several times the transition plans and you made regard to the implementation plans. So what do we expect in concrete terms and by when? You have timelines and milestones for these transition plans. Can you give a little bit insight more?
Yeah, so let me also describe a little bit where we're coming from. But the economy is moving and changes on path towards the Paris goals. So economic sectors will have to adjust how they operate and respond to both a greener consumer preference and new public policies. So banks must incorporate these structural changes in their strategic considerations and decision-making and steer their businesses towards a smooth transition to carbon neutrality. In its sustainable finance strategy, the Commission acknowledges the need for financial institutions to improve their disclosures of sustainable targets and transition planning. In addition, the Commission's proposal for a corporate sustainability reporting directive requires financial institutions to set out and disclose their transition plans, but it leaves their content and timing to the discretion of each bank without stipulating any clear metrics, milestones, or targets. In my view, both the legislative initiatives currently underway and the industry's own acknowledgement of the importance of moving to transition robust business models implies that banks need transition plans compatible with EU policies implementing the Paris Agreement, with concrete intermediate steps to enhance their long-term strategies and decision-making. These transition plans should highlight at any given point in time from now until 2050, so the time when we should have carbon neutrality in Europe, the bank's alignment and potential divergences with the relevant policy objectives through which the EU implements the Paris Agreement. Such a transition plan should be part of a bank's strategy setting and be closely linked to its business model and business plan. It should contain concrete intermediate milestones from now until 2050 and the associated key and performance indicators so that the bank's management and the competent authorities can at all time understand the risks arising from a possible misalignment with the transition path. If a bank fails to meet these milestones, the authorities will have to take appropriate measures to ensure that this failure does not result in financial risks. Now, for the ECB banking supervision, the main concern is the level of banks' risk exposure. Have the exposures been sufficiently mitigated and are they prudent? Have the banks sufficiently taken into account the economy's adaptation to the climate crisis and the associated changes in consumer preferences? As C&E risks become increasingly widespread and more material, banks will inevitably be exposed to them. So from a supervisory perspective, adequate mitigation therefore needs to be in place. We see that more and more banks are realizing this and are taking up commitments to this end. This creates a space for us to act as a supervisor, but in addition to banks' exposures to an economy increasingly marred by climate change and banks' own stated intention, a legal obligation for banks to have a clear and detailed and prudent transition plan in place would increase the consistency of the regulatory and the supervisory framework and contribute to maintaining a level playing field. So this would be something to consider, to be honest. In the same vein, The ECB's focus on these transition plans would be less on the year 2050, but rather on the intermediate points in time. So 25, 30, 35, 40. And why? This is because detailed plans featuring milestones have been widely used by banks to manage other risks. So one example, obviously, is our demand to have disposal plans for non-performing loans. We have had very good experience in this regard. And secondly, because our benchmarking shows that banks systematically fail to establish a clear link between their stated carbon emission goals for 2050, so zero, and their concrete actions in the present and medium term. Indeed, we see that some banks state that banks that declare carbon neutrality by 2050 have no strategy in place to reduce their exposures to carbon-intensive industries by 2030, nor have they made any progress in assessing their role in financing the transition of such companies. Even if banks comply with our supervisory expectations for the management and disclosure of C&D risks, that does not automatically mean that they have a Paris-compliant transition plan. And this is why I believe that having in place a formal legally binding requirement to adopt such transition plans will push banks to go beyond the mere point-in-time measurement of C&D risks and to embark on a thorough assessment of the structural changes that are likely to occur within the industries they derive their business from. Transition plans should become the next addition to banks' risk management practices, but they in no way preempt the supervisory dialogue with banks on their risk management capabilities. They are simply another element to ensure that banks manage all material risks. One we have been insisting on specifically with regard to C&D risks since 2020. Getting banks to develop action plans to comply with the expectations that the ECB sets out in its guide on C&D risks was the first step in getting them to assess and develop their risk management capabilities. Transition planning is a second step, and one that will help banks to effectively develop a mitigation strategy to soften long-term impacts. Transition planning still concerns risk management capabilities insofar as we expect banks to build on their current ones and apply them extensively. This is to ensure that bank strategies are sustainable as the wider economy transitions into greener production patterns and consumer preferences. At the same time, we will continue to roll out other elements of our climate strategy. As mentioned beforehand, in the course of next year, we will conduct a supervisory stress test with a focus on C&D risks. In addition, we will carry out a full supervisory review of banks' practices to incorporate C&D risks into their risk frameworks and gradually roll out a dedicated SREP methodology that will eventually influence banks' minimum capital requirements. But this is not the end game, as I mentioned before. Gradually, we will start treating climate-related risks like any other risks and include them in all supervisory requirements. So I stop with this and hand over to you. Thanks, Lothar.
Thanks, Thomas. So you mentioned the full supervisory review of banks' practices, the dedicated SREP methodology, and the upcoming climate change stress test. So it's like a little repetition. What do you think are the biggest challenges from your point of view with concern to the supervisors and to the banks as well? And can you describe the basic elements of next year's stress test once again? And how will it be used as part of your future supervisory work?
So first of all, I would say the biggest, we had interaction with the banks. We spoke with them about our expectations. But what is clear from my perspective is that developing models which capture climate and environmental risks in their day-to-day work, in assessing credit risk, market risk, etc., liquidity risk, this will, from what I see right now, be the biggest challenge for banks. Yeah, we will integrate into our methodology for the SREP different elements and criteria how climate risk and environmental risks will affect the different elements of our SREP process. So the business model, risk management and governance, the risks to capital and the risks to liquidity. So this will all be adapted in some sense in order to reflect this properly. But then you also mentioned that we have next year a stress test. And I mentioned before, this is for both parties, so for the banks, but also for us, a learning exercise. Yeah, it's one of the objectives is to enhance the capacity of both banks and us to assess climate risks. In this context, the quality assurance process also serves to enhance the supervisory understanding of what climate relevant data banks have available and the limitations when assessing climate related risks, to identify best practices and to ensure that banks follow the instructions as set out in the methodology. In line with the proportionality principle, the intensity and granularity of the quality assurance conducted by the ECB for banks participating in this exercise will be commensurate with the materiality of the issues identified. We will conduct the exercise from March 22 to July 22, and it will comprise several phases, including data collection, a quality assurance, and finally, of course, the computation of the results. In phase one, we have the data collection, so banks will be required to complete templates and produce results based on instructions set out in the methodology. In phase two, the quality assurance phase, the ECB will analyze the information submitted by banks to ensure that the submissions are, first of all, of satisfactory quality, to align, they are aligned with the instructions set out in the methodology, and third, that they provide a comprehensive and reliable results for the prescribed assumptions and scenarios. The stress test will then consist of 3 modules. So module 1 is the qualitative questionnaire. So the purpose of this module is to gain an illustrative overview of an institution's internally available stress testing capability and capacity, including its climate risk stress testing framework, management and modeling practices. The questions in the survey concern qualitative information on the institution's current practices. So it will comprise 11 blocks. So 1 to 10 concern the day-to-day internal stress testing framework of the institution. And block 11 will concern the assumptions developed by the bank in the context of the 2020 climate risk stress test exercise. Module 2 will then request banks to calculate climate metrics, yeah? And this will be, I guess, in terms of data collection, one of the key parts. So in 2022 climate risk stress test exercises, the banks are requested to provide a set of common climate-related metrics. Banks are requested to fill in the templates on Module 2, which focuses on 2 climate risk metrics. The metrics have been designed to shed lights on banks' analytical and data capabilities regarding climate risk. More specifically, the metrics provide insights into the sensitivity of banks' income to transition risks, their exposure to carbon-intensive industries, and in that sense, the sustainability of the bank's business model. The designed metrics give banks the opportunity to start building their databases and collecting climate-related data that will help them meet future regulatory requirements. So metric 1 will then be interest, fee, and commission income from greenhouse gas-intensive industries, to measure sensitivity of banks' business model to greenhouse gas-intensive sectors as a proxy for the implementation or implications of transition risks. The second metric will be financed greenhouse gas emissions, so to measure the exposure to carbon-intensive industries. So banks are expected to provide the necessary data to calculate a weighted average intensity metric. Yeah, and then last but not least, Module 3 will represent the bottom-up stress testing projections. The purpose of this exercise is to describe the methodology and requirements for the starting point data and projections that banks must provide for the bottom-up stress test exercise. So we're targeting transition risk and physical risks, of course. Thanks a lot, Lothar.
Okay, thanks, Thomas. That will be a great exercise, will become a great stress test, I think so. So my last question, let me switch over to COP26. I just mentioned it at the beginning, the UN Climate Change Conference in Glasgow, which ends tomorrow. And I mentioned in our session at the beginning, Frank Elderson, and he published and he presented on the 3rd of November the Glasgow Declaration of the Network for Greening the Financial System, called Committed to Action. Not only willing to action, but committed to action. Would you be so kind and tell us the main expectations out of this network for the next month, and what banks can take from this declaration?
Thanks. Yeah, you mentioned that there will be a Glasgow declaration which is called Committed to Action, and in which basically the participants to this declaration reiterate their willingness to contribute to the global response required to meet the objectives of the Paris Agreement. It also makes concrete commitments on what the members will work on and deliver in the coming years, covering all the core activities of the network of central banks and supervisors, so the NGFS. Looking ahead, the network will deepen, amplify, and strengthen the collective work and efforts. It will continue to make the financial system more resilient to climate-related environmental risks, encourage the scaling up of the financing flows needed to support the transition towards a sustainable economy. To do so in the coming years, the NGFS will further enhance and enrich its climate scenarios. We will deepen our analytical work on how climate change might be taken into account in the conduct of monetary policy as well. It will intensify the work to bridge climate-related data gaps. It will publish guidelines on a task force on climate-related financial disclosures, aligned reporting for central banks. It will also want to step up efforts on capacity building with a particular focus on members from emerging and developing economies. And the network will also want to continue to explore emerging topics such as the impact of the biodiversity loss or the risks associated with climate-related litigation, and work towards addressing them. On top, many, I think 2/3 of the NGFS members are taking the opportunity to publish an individual pledge or strategy. So basically all of this, so the individual action and the action of the network together, they, I think, demonstrate that this network is determined to act and fulfill its responsibility to set itself. Back to you, Lothar.
Thanks, Thomas. So let's come to an end. It was a very nice and, I hope, informative power talk. And ladies and gentlemen, I hope you have got some good and new insights. Let me sum up this last hour with 2 points. First is the financial sector has to play a key role in greening our economies. Therefore, climate-related target setting with clear yardsticks and, as just mentioned, gathering the right metrics and the right scenarios will become essential. Data needed should come from, let's say, generally recognized and accepted data repositories from the NGFS or whom else. And they all are necessary for reliable transition plans. And second, supervisors have an important role to play that banks incorporate climate change risks. Therefore, ECB climate risk test will become more important than a lot of bankers may expect up to now. And I do hope that supervisors later on share their views and the best practices with all banks, not even those of the significant institutions. And let me make a point from a very personal point of view. And I would raise a proposal, might be to politicians or governments. Banks need not only new regulatory and supervisory guidelines and requirements, but they all need incentives. Because transforming our economies in a whole and globally, on a globally basis, to net zero activities must be economical, profitable at the end. That's a personal point of view. So let's finish here. Thanks again to Dr. Thomas Stettner from the ECB Banking Supervision. And I move over to the head office in Frankfurt, and I hope Carsten Lehr may start in some minutes with the next session 5, efficient ways towards a true green capital markets union. Thanks to you all. Bye-bye. Stay healthy.
Thanks, Lothar.
Good afternoon and a hearty welcome to the fifth and final session of today's European Round Table. I heartily welcome all of you, and I hope there are still enough in the audience to follow this following session on efficient ways towards a true green capital market union. A short introduction from my side into the topic. In 2015, the former president of the EU Commission, Jean-Claude Juncker, gave the concrete impetus for the implementation of the Capital Market Union, planned as a deepening of the capital markets in the member states of the European Union. The Capital Market Union is intended to deepen and expand the free movement of capital, one of the four fundamental freedoms of the European single market, since the progress made so far is still fragmented and predominantly nationally oriented. The European Green Deal is a concept presented by the European Commission under Ursula von der Leyen in December 2019, with the aim of reducing net greenhouse gas emission in the European Union to zero by 2050, and thus becoming the first continent to become climate neutral. This development is going to be very expensive. New ways of combining traditional financing but incorporating environmentally positive results led to what we call green financing. Over the past 18 months, the COVID-19 has changed the lives of billions of people across the world and caused significant economic and social disruption. The pandemic has also driven an increased focus on the importance of long-term stability, accelerating the environmental, social, and governance agenda, and triggering improvements in the way ESG risk is governed and managed. There is unprecedented momentum to embed ESG into banking and to ensure that the whole financial sector plays a key role in driving the transition to a sustainable economy. Neither the CMU has been established, nor the pandemic overcome, nor clear, concrete, and substantial actions have been decided or undertaken on the several UN climate changes conferences. Therefore, the title of our panel today states "Efficient Ways Towards a True Green Capital Market Union" calls for a discussion. And it's my pleasure to have this discussion with the following three experts: Nina Schindler, Paul Hiebert, and Brian Hayes. Let me give a short intro of their CV. Nina Schindler was appointed as Chief Executive Officer at the European Association of Cooperative Banks in Brussels in February 2021. As senior executive with more than 15 years of international experience in the financial services sector, Nina gained deep knowledge during her career on EU policy, advocacy, communication, regulatory management, and business strategy. Graduated as a lawyer in Germany, Nina started her professional life as advisor at the EACB in 2005, before moving to the Association of German Banks in 2007. A little bit later, Nina was commissioned to restructuring the EU representation of Commerzbank. And after that, she took up a new role as Deutsche Bank, where she became the head of government and public affairs EU. Nina is a member of various committees at the European Payment Council, the European Financial Reporting Advisory Group, as well as at the European Banking Industry Committee. Paul Hiebert, he's heading the Systemic Risk and Financial Institutions divisions of the European Central Bank in Frankfurt. In this role, he leads systemic risk analysis for the Euro area, feeding into the ECB's flagship, the Financial Stability Review. Paul has also been leading climate-related initiatives of the European Systemic Risk Board, as well as for the Basel Committee on Banking Supervision. Paul has experience of over 20 years in different organizations, so ECB, International Monetary Fund, the Reserve Bank of Australia, as well as in the Canadian Department of Finance. He has published on a diverse set of topics, including financial cycles, climate change, global banking, macroprudential policy, and so forth. Our last panelist, Brian Hayes, has a colored career. So he studied at the well-known Trinity College in Dublin and at St. Patrick's College, Maynooth. He served as a member of both houses of the Irish Parliament from 1996 to 2014. In 2011, he was appointed as a Minister of State at the Department of Finance. And during this time as Minister, Brian attended the Eurogroup, ECOFIN, Budgetary Council meetings on behalf of the Irish government. So you're a deep insider, Brian, on the political issues. Following his election to the European Parliament in May 2014, Brian was appointed to the European Parliament's Economic and Monetary Affairs Committee and also elected as Vice President of Econ. He was the Vice Coordinator of Econ for the European People's Party. Brian was European Parliament's rapporteur on different issues like the money market fund regulation or the pan-European pension fund proposal. He also worked on the European Parliament's first ever report on fintech and on the subject of the third country equivalence. Brian now leads the Irish Banking, Payments and Fintech Industry Association, BPFI, in Dublin. As CEO, he's actually aware of the challenges facing the retail banking sector in the post-banking union environment. The BPFI deals with issues on digital transition, sustainable finance, fraud, and AML issues. So it's now up to all of my three panelists to give an introductory statement following the order given in the program. So Brian, the digital floor is yours.
Thank you very much indeed, Karsten, for the introduction, and good afternoon, ladies and gentlemen. And it's good to see our fellow panelists on for this last session, I understand, of the European Round Table. And congratulations to you for all of the work that was going on today. I think this is a crucially important issue, the connection between CMU and sustainability and how we are going to achieve a true capital markets in the European Union. Just a very brief note about our own organization, the Banking and Payments Federation of Ireland. We represent, I suppose, the banking, payment, fintech landscape ecosystem here in Ireland, representing wholesale, retail, international and domestic banks, but also payment service companies and big and small technology companies who are partnering with our banks. So we're very much part of the ecosystem. We're also members of the European Banking Federation. And with our colleagues in the EBF, we work closely with all European stakeholders in developing and bringing forward the true capital market that I think we all want to see. As an opening comment, I think it's really important to say that during the past 18 months to 2 years of this COVID crisis, I think the banks have responded really well to the challenges that we've had to face. We've had to live through a real life stress test environment. And I think it has shown that the kind of post-crash regulation and legislation that was put through under banking union, in terms of, especially in terms of liquidity and capital, has proven to be successful. I know some of the losses have yet to be crystallized under non-performing loans, and some of that will be allied to as government reduces its support to businesses as we go forward. But I think we've seen a really good cooperation between regulators, public authorities, and industry, especially the supports that we got in terms of the quick fix package from the ECB, SSM, but also the public measures. And the reason I raise this issue, I think as we go forward and we begin to refocus our energies on developing a green capital market, that engagement, dialogue, and trust, I think, that has been established between the sector and regulators and supervisors over the course of the last 2 years will put us in good stead about the kind of steps we need to make to develop this really liquid capital markets union, where we can link up investors and pools of resources with new opportunities across the European Union. So despite the fact that the last 2 years have probably taken the focus away from CMU and a true green capital markets union, we now need to get back to that quickly. And I think the last 2 years have really helped that debate from the perspective of dialogue between all concerns. It is inevitable that we should return to this question, not just because of COP and not just because of the really important EU Green Deal that the President of the Commission announced as a key priority going into this new Commission. But it's important that we should do that we accelerate what we need to see across all of our banks in terms of not just their own engagement with clients, corporate SMEs and retail clients, but also with their own business models. I thought there was a very interesting point made yesterday by Mr. Enria when he spoke at the ECB dialogue around the importance of banks getting their cost structure in place, focusing more on their models for a sustainable future, and obviously refocusing their energy on digitalization and the kind of investment we need to see. And I think the last 2 years, to use his words, helped the banking industry kind of turn the corner because of the test of COVID. So we have to make this transition. It is a baseline scenario. It's not just about the climate and the importance of climate. It's also about the importance of a sustainable business model for the future for this industry. We have a long road ahead of us. Somewhere in north of 100 trillion to 130 trillion needs to be provided to make the transition a reality. And we've taken baby steps so far. And Europe, I think, has led the way. I mean, half of the issuance done in terms of the existing capital investment has come from Europe, and others need to shoulder that responsibility as we go forward. Take a small country like Ireland. Typically in a year, somewhere between 30 to 40 billion of new credit is provided by the Irish banking system to all of our customers, big and small. The IMF recently said about Ireland that if you take between now and 2030, but at least 20 billion a year needs to be provided in additional capital. Now, if you take maybe a third of that is public investment, public support, 2/3 of it will be provided by private placement and private credit. And that's about 14 to 15 billion a year. So it's an extraordinary step up in the credit capacity that Ireland and every other country needs to provide if we're going to make this transition happen, and we've got to do it. And my last remark on that, before really listing where I see the kind of the steps we need to take, is this. I don't see, in the debate that happened in 2015 when I was in Parliament, it was some member states took the view that this is about dislodging banks and traditionally moving away from the kind of traditional model of intermediacy that we have in Europe. I don't see it that way at all. This is about, if anything, complementing the works of the Irish and international and European banking sector, that actually developing a true capital markets union is good for the banking sector on a medium and long-term basis. It's also good, of course, for the placement of capital. So I don't see it as an either-or debate. And it's not the case that we're going to dramatically change overnight the kind of culture of lending that exists in the European Union to what we've seen in America, for instance, the 75-80% model that we have here. It's going to take a long period of time, but actually this is a transformation that will be just as important for the European banking system to embrace as it will be for the future of lending in Europe. And I think that's an important point to say. So very briefly, if I could go through what I see the 5 key areas about how we will actually make this transition and connecting up CMU with the green transition. What are the efficient ways? Well, I think number one, we need to recognize some of the mistakes that were made in 2015. It wasn't through a lack of commission or lack of resolution by the Commission or anything like that, but I think mistakes were made in 2015. I think we need to learn the lessons of that. On things like securitization, we got caught up, I think, in a kind of a arbitrary discussion about risk retention in terms of STS, which actually didn't make sense, and we're going to have to revisit that now. So I think it's really important that we learn those lessons. We lost focus in terms of the things that we had to do in 2015. Some good work on prospectus, crowdfunding, money market reform, good work as well in changing some of the financial instruments for a long-term investment. All of that was good, but we still face huge blockages there in terms of country by country insolvency rules, withholding tax rules. These are all blockers in trying to really create an integrated CMU market across the European Union. So I think we've got to recognize some of those mistakes, and in trying to get back to the kind of platform that the Commission have, which they announced more recently, the 16 actions, we need to inject some pace in those to make sure, some of them are legislative, others aren't, to make sure that we can get working on that. The second thing I think we need is policy certainty, which we don't have right now. From an industry perspective, things like the transition finance, as balance sheet assets move from brown to green, what exactly is the trajectory there, and when will we get some certainty on that? I think that's important. Carbon pricing, we need some certainty there. Also in the area of standardized reporting, I mean, data is crucial in this area if we're going to quantify the progress in the transition. We still await some real policy certainty there. And if you speak to US banks vis-a-vis European banks, the difference they say, I think, in the system is that there is more policy certainty at a US level, which is something that I think we need to learn the lessons from an EU level as well. And also some certainty in the area of public investment. I think that's going to be important as well. So my first ask towards the efficient way forward is certainly around learning the mistakes of 2015, not repeating them. Secondly, policy certainty and all of the tools that are needed to make the transition. Thirdly, I would say we need to have more ambition with projects coming forward. I know the European Investment Bank is very strong on this issue about really important investments that actually can make the transition on a cross-border level. We need to see ambition there. And that's something that is going to be crucial if we're going to get more efficient ways of the distribution mechanism coming from CMU. Fourthly, I would say, and I say this from a kind of a local perspective, we need to respect the fact that we have diverse locations for capital appreciation and capital engineering across the European Union. And that's good for the European Union. Having a diverse system with a level playing field. So having the likes of Luxembourg and Dublin and Amsterdam, working with Paris and Frankfurt and Berlin and other member states, that diversity is good, because I think if you look even at the Irish market, there's a lot of skill here in areas like securitization that goes back pre-crisis, which can be resuscitated and used again as an essential ingredient towards CMU. So I think it's really important that we have that those diverse locations. If you take one example from one of our businesses here in Dublin, in the most recent European bond that was issued, a third of that syndication and issuance happened here in Dublin by a Canadian investment bank that is based here in Dublin. So rather than seeing this as some kind of European exclusive issue, we need to use the diversity of our markets across the European Union to play to the strengths of the kind of fundamental EU requirement that is needed, especially on the Green Deal, as the Commission President said. And finally, I think we need to do much more on the digital adaptation. We need to learn the lessons of COVID in that, and how we can utilize the digital adaptation and transformation for the purposes of developing a proper CMU across Europe, especially on the retail side. My final remark is I heard recently the CEO of IKEA, a wonderful EU-wide business, make the point in terms of a recent survey that was concluded across all of their customer base, that 70% of people that they surveyed believed that passionately in the green transition, but only about 3% of the people were prepared to pay for environmental funded projects. And I think his response to that was, we need to be ambitious, we need to encourage people, and we also need to build on our strengths. And as we go forward, as we try to really make this transition a reality, we've got to build on those strengths. And I think the European banking system has a lot of strengths in the area of capital markets. We have to build on that rather than try to create some kind of new edifice. Thank you, Carlton.
Many thanks, Brian. So Nina, it's up to you. Go ahead, please.
Thanks a lot. I would like to start to thank the organizers of the European SSM Round Table and its host, the Central Bank of Ireland, for inviting the ECB and myself to shed our light on the topic of a true green capital market union. It's a great pleasure to be here. As a representative of larger and smaller retail-orientated banks, I will focus my intervention very much on the retail investor perspective. But let me first briefly outline for the members of the audience that do not know the ESCB, what the essential difference between cooperative banks and other banks is. The legal form of enterprise that the ESCB member banks are based on is that of the cooperative. This means that customers can become members of the bank under the one person, one vote policy regarding of full of number of shares owned. The objective of cooperative banks is not profit maximization, but rather shareholder value maximization, meaning that revenues are acquired to ensure the longer term stability of the bank in the interest of its members. To achieve this, cooperative banks promote the social, environmental, and economic well-being of the communities they belong to. They also have a strong governance model in which they foresee client influence in the policy-making process. As a result of their model, As a result of their model, cooperative banks tend to have a strong physical presence, not only in the economic centers of European member states, but also in the more remote areas. All this helps cooperative banks to drive sustainable growth in the real economy, also on local and regional level, through their significant market exposures to consumers, SMEs, and communities. It's a key goal of cooperative banks to leave no one behind. So how and why is the ESCB interested in a true green capital market union? Well, our banks take an active role in embarking the retail clients in the green transition by promoting within their network the distribution of services, investment, or saving products in favor of sustainable development. At a capital market level, our members mainly provide investment advice within the scope of MiFID II, and thus are particularly interested in the distributor's obligation to the clients when first determining the sustainability of an ESG product to a client, and second, providing the necessary ESG disclosure for better investor protection. Some of our members provide portfolio management, and therefore we look also into the relationship between manufacturer and distributor when identifying the target market of the financial product. Finally, ESCB members have been frontrunners in green bonds. Our focus in the Capital Market Union context is thus first on sustainable finance disclosure regulation, secondly, the ESG amendments to the delegated acts to MiFID, and finally, the regulation on the establishment of an EU green bond standard. Speaking about sustainable finance disclosure, our members have, for the past few years, been trying as much as possible to prepare an ESG product offer for retail clients, but they have not been able to make conclusive choices yet, as there still is unclarity how to apply the definitions at the level 1 of sustainable finance disclosure regulation. ESCB members have worked internally and with market standardization bodies to determine in a consistent way how to classify products under the term sustainable investment in the regulation so as to prevent greenwashing. The Commission issued Q&As tackling the topic of product classification back in July, but these are still a bit unclear and may potentially need to be revised. The bottom line for us is the client should be able to trust what they are investing in, really delivers on their sustainability preferences, and this is what we aim to achieve. However, the unclear provisions and the other issues prohibit the product offering and provision of investment advice. And this makes it hard for ESG products to be offered to clients who are less financially educated or less wealthy. As per our cooperative banking ethos, we struggle to face this lack of inclusivity. Speaking of sustainability preference, This leads us to the new ESG regime under MiFID. The concept of sustainability preferences being determined by the client under these regimes does not make the process of green transition simple for clients. Frankly, how can they be expected to be able to formulate minimum sustainability criteria to be determined to meet both their financial and non-financial needs? This is clearly the job of financial advisors, simply put. On these two main work streams, SFDR and MiFID, we look forward to engaging with the Commission regarding its new actions under the renewed sustainable finance strategy. First, regarding the proposal to develop a minimum sustainability criteria for products which do not clearly fit under the term sustainable investment, but do promote environmental and social characteristics. And secondly, a proposal to determine a common qualification regarding the expertise of financial advisors regarding sustainable finance. Of course, these issues are all depending on underlying environmental product classification system developed under the taxonomy and the upcoming social taxonomy. Currently, the SFDR and MiFID delegated acts rely on the various delegated acts under the taxonomy in order to be implemented, and yet these have not been completed or published. Furthermore, the SFDR Level 2 provisions were already meant to apply, and yet the final RTS are still pending publication. These delays in publication really leave our members with the practical challenge in implementing the various regulations, which translate to decelerating the green transition. The ESCB has, over the last few years, been engaged with the Commission in order to address these sequency issues, timing inconsistency, and overlaps in the various legal texts. And we hope that these could be resolved with immediate attention. Apart from the sequency issues, we also see the urgent need for alignment between SFDR, taxonomy, product classification and definitions with the various eco-labels that are under the development currently. Clients will have high expectation with such labels, and so we need to get it right in order to take major step in the transition towards a greener economy. I guess the best way to do that is to invest in something that supports the green transition. Investing in something that is already green is also good, but of course will not be enough. The investor needs to understand the differences, and labels may need to reflect that. We also call for EU green bond standard to be based on fully published and implemented taxonomy delegated acts rather than draft legal text. This will ensure a credible standard for green bonds in the EU. Furthermore, may I refer to the retail investment strategy. The outcome of the Commission's retail investment strategy is eagerly awaited by the ESCB, but raises concern if this will propose changes that are not properly aligned time-wise and that further add to the complexity of disclosure issues. Retail investors have already struggled with the information overload and lack of simplified disclosure under MiFID and PRIPS recently. The SFDR RTS, for example, already requires a lot of implementation costs for our members. And if there are also amendments upcoming for related sectorial legislation in capital markets, then this could be very confusing to clients and costly to companies. The plethora of pre-contractual and post-trade disclosure and periodic reporting is already quite hefty without the sustainable finance universe. As a final remark, I wish to highlight that regulation such as taxonomy or SFDR will also put strain on investors and our members with respect to the volume of ESG data required. Brian already mentioned the key thing of availability of ESG data. At the moment, the lack of access and the lack of quality of ESG data is a huge issue, in particular for cooperative banks whose portfolios are mainly focused by SMEs. and not big companies who might have it more easily available. We call regulators to ensure that effective tools are developed to improve that standardization and availability of climate-related data. The new Corporate Sustainability Reporting Directive and the current work on the EU's sustainability standards are a step in the right direction. However, as I said before, we need simplified tools for SMEs. In particular, the ESCB calls for a fast progress on European single access point under the Capital Market Union in order to have in its scope both financial and non-financial information. And we also support a Green Deal data hub within environmental accounting information for member states and a greenhouse gas emission data from industry, as well as for physical risk monitoring data. This would allow the financial sector and companies to achieve a unified detection of climate consideration and increase climate change resilience. We hope that all these efforts from cooperative banks will ensure a just transition to a greener economy that is inclusive and sets an example on a global level. Thanks a lot for giving me the floor.
Thank you very much, Nina. I was just wondering where we want to leave for dinner, because you both laid already the ground for a long, long discussion, getting into much details. But Paul, it's now up to you for your introductory statement, and then we jump into our discussion. Thank you.
Thanks a lot, Carsten, and great to be with you here in this panel. As you might not be surprised, I will try to complement what Brian and Nina have already presented with the prudential risk angle, which is effectively the regulatory world in which I reside. We have some slides to share. I think they look a little bit small, but maybe if we can get those bigger. For those who can see them, obviously we can share them after the event as well, based on published material. So all of the references are in those slides. If I motor through them and power through them, perhaps in the interest of time to get to a good Q&A, please forgive me, but as I say, the references are there. Now, I want to make 5 points in my opening remarks, and they are the following. The first is that basically climate is science itself. The second would be about financial markets. Third, about exposures. Fourth, about how we take that forward. And fifth, about the CMU link. And let me go in detail about each just very quickly. I think the first point is climate shocks, in our view, are inevitable. They're already baseline. It's no longer risk. And we have to think about climate shocks in those terms. The secondly is, given that those climate shocks are inevitable, financial market repricing you might expect to be in place. But arguably, much of that still has yet to come in our view. The third issue is really that financial exposures then start to matter. Exposures of financial institutions that are important systemically, like banks, but also non-bank financial intermediaries, which might be of interest to us. And we are concerned about concentrations. Fourth is going to be this idea if we take it forward in terms of looking at trade-offs, so physical risk, transition risk. Because transition risk, that is the issue. Too fast, you want to be too slow. You want to get it just right. And I think that suggests timely action is probably, and resolute action is the best path forward. And last thing aside of CMU, I'll come to some concluding remarks. So let me go through each of those points very quickly, just with some pictures. So I'll go to the next slide in the deck. And basically that's this first point. Climate shocks are inevitable in our view. So you often hear this Mark Carney 2016 remark, tragedy of the horizon. So in our reading of the data and dialogue with scientists through the Network for Greening the Financial System, it's no longer just a long-term issue at this stage. What we see, and if you can see the slide, I'm not entirely sure, but let's say I'll just talk you through it anyway. Is the left-hand side of this particular chart would suggest we've already exhausted much of our carbon budget already. So the IPCC, the Intergovernmental Panel on Climate Change, so eminent scientists around the world note that we're already 1.1 degrees of warming already has occurred. So we have 0.4 degrees until we're at that pivotal 1.5 degree warming point, very little. And the 2 degree point is also not that far away. Now, the right-hand side chart is just telling us that, effectively, we have a major gap between pledges and targets from the Paris Agreement, which is in the blue shaded area, and actually what we would need in a yellow shaded trajectory if it were to actually comply with a 1.5 degree global warming scenario. Now, 1.5 versus 2 degrees sounds quite small to us, but actually quite large. 1.5 versus 2 degrees is about ice-free Arctic summers 1 out of 10 years instead of 1 out of 100 years. Or the share of world population exposed to severe heat waves in the last 5 years, so be one of those years, would be around 37% instead of 14% if we're in a 2 degrees warming situation. So it is important, it's meaningful. And I think that the point to get to the horizon is, it's not that adjustments should take place in 10 years or 20 years, as we often decades here. It's actually next year, the year after. There has to be this sort of sustained adjustment we would expect to see in the type of lockdowns we had in 2020 led us to around the type of annual reduction in carbon intensity we would expect. So no free lunch here. Next chart gets me to the second point. If that is inevitable, we would expect financial market pricing to be there to price in this inevitability. But it certainly is not there. Although what you see is markets are developing quickly, which you can see with a glass half empty or glass half full hat on. So on the left-hand side part of this particular slide, what we show here, if I go forward one slide, is the idea that we have exponential growth across all green market capacities. And that's from bonds to ESG, but a bit less in the derivative space and the risk management. So it seems markets are more focused on opportunities than they are in risk management per se, in terms of development. Labeled green bonds in particular is important. It now exceeds around 500 billion in Europe. And the issuance has been around 20 or 30% per annum for several consecutive years. Also funds with an ESG mandate, around 170% growth over the last 6 or so years. Except if you put in contrast to that, catastrophe bonds or emissions derivatives still remain really tiny. Now what we see is on the right-hand side part of this chart is that if you take a look in a detailed look, and all of these charts are in a report that is referenced here in this slide, is that you have basically the UCITS funds, which our colleagues at the European Securities Market Regulator have in Paris, done a very detailed look of 17 or 18,000 of these portfolios. And what they see is effectively, there's a very much their portfolios are tilted towards brown, so high emitting firms. Around 55% of their portfolios are in high emission brown firms. And that suggests that there's a lot of heavy lifting still ahead of us, with only 11% on average in green firms, and an estimated alignment with the EU taxonomy of only 1% of total assets. So clearly that adjustment is coming. And if I go to the next slide, what it suggests is that, and I think Nina touched upon this already, we have very severe informational problems that are collectively creating a market failure upon which allocative decisions in markets need to be predicated. You need to basically fix this. And 3 different issues are important. And when I say they need to be fixed, there are a lot of initiatives in play also in the work of the European Commission, very helpful work in doing so in 3 respects. So one is about the quantum of data actually disclosed. It's incomplete. We have selection bias in firm reporting. It is a voluntary standard for now worldwide and also here in Europe, and moves to make that mandatory, of course, are going to be very helpful. They're inconsistent. We have a lack of accepted methodology for defining green and brown assets, and that's very difficult, and that needs to be validated and certified. Again, efforts are underway. And lastly, after incomplete data, inconsistent data, so the quality of data, is about insufficient data, and that's downstream reporting, so for instance, scope 3 and the like, still is very patchy, and a lot of estimates are there. What we see is that ESG scores in this chart you see on the left don't tend to line up as you'd expect them to do. And also banks, of course, are potentially then have difficulties with this because their portfolios themselves not reporting means that they themselves have difficulty in reporting their own scope 3 downstream emissions. Next slide just tells us to the third point I want to make, this idea, climate shocks are inevitable, financial markets not pricing in earnest. Third point is we see financial exposures suggesting significant concentrations. So let me start on the side of physical risk and turn to transition risk. So climate hazards, what we see here is that there's certainly an important country or regional concentration of climate hazards. You can see the left 2 charts here, either in a map setting or in this heat map setting according to the corporates and how they line up in terms of the percentage of corporates at risk. What we see is that floods tend to be pretty widespread as a driver, but then you have wildfires, heat stress, water stress, quite important for some specific regions. And the right-hand side chart is, I think, the most interesting here. You take all this climate and economic impacts and you map it into actually financial issues. Here we see that around 30% of banking sector assets could be exposed to higher increasing physical risk. And that is basically when you look at across all of the physical risk hazards. So clearly, holdings are an issue. Next slide. This gets us to the system-wide perspective. Again, the interplay between banks and markets, which will be at the core of the CMU question when we think about the heavy lifting, which Brian said has to be carried across the private sector and public sector. And that's the idea that exposures tend to have 2 forms of mitigants behind them. One is collateral, which is the left-hand side chart here. you can see that real estate, and in particular physical assets, in particular real estate, is really what backs the majority of exposures from banks. So you could have this wrong way risk in a way. We have, physical risk hitting in a particular setting, the collateral is self-compromised at the same time. Perhaps more importantly is the right-hand side part of this chart, which is this heat map on insurance, suggesting that an insurance protection gap could be in play at the moment, even before looking forward with potential changes to the way insurers treat climate risk. Only 35% of economically relevant climate losses in the EU are estimated to be currently insured, and that varies a lot by jurisdiction. Next slide is just quickly to round out transition risk, and that's been talked about a bit, so I don't have to belabor the point. But the concentration is both at the sectoral level, and this chart on the left now gives us a bit about the scopes of emissions, so scopes 1, 2, 3, which are in the middle bars. What you see is it depends on the sector to what extent we're concerned, and certainly for banks exposures, places like manufacturing are just as important because they have 1/5 of loan exposures than, say, electricity and mining, which is only around 5% of bank exposures. So arguably, if you think about enlarging scope to scope 3, the potential repricing is large. And the right-hand side chart here is just really telling us the sector of allocation of a particular firm only tells part of the story. There's a huge variation within sectors, suggesting there could be quite discriminatory pricing or thinking by credit rating agencies as we go forward. So next slide will just tell us, I've built a story about exposures. What about a forward-looking question? How might those evolve? And what we've seen so far in our work, and we've just published a climate stress test here at the ECB in September, top-down, in advance of the bottom-up exercise the SSM will be running next year. And you can find it on our web, of course. It's referenced here. It's the idea that I think a couple of stories are interesting in that paper, at a minimum, and it's quite a rich paper, so I'd encourage you to read if you haven't done already. On the left-hand side is the idea that if you group sectors by industry classification, what you see is that across scenarios, so an orderly one, we have transition risk, like as much as it needs to be, but minimized, the physical risk not increasing accordingly very, very strongly. Or you have a disorderly with too much transition risk, or a hothouse world with too much physical risk, is the alternative adverse scenarios. What you see is that there's more costly effectively to do nothing. So action up front is very beneficial in terms of its long-term benefits, and particularly with the green diamonds here for the highest emitting firms, which would be real casualties of failing to adjust in a timely way. Right-hand side chart just gives you an idea about the time profile, and in our view, physical will start to become dominant in Europe and around the early part of the next decade. So there's a limited amount of time to deal with this. Now, the last slide, if we go forward one slide, just before I break for the comments, so the Q&A, I should say, is the idea that CMU, it's hard to manage this without the financing that would come from CMU. So CMU is going to provide us, effectively the capital markets counterpart to what banks will be expected to do. And banks can only manage part of the heavy lifting based on what we see so far. The green bonds market is around 3 times the green loans market, for instance. So clearly markets are already doing quite a bit of issuing. Of course, there is this issue of greenwashing. We have to be worried about that. But what is true is that the collective number will need to be big. What we see from the European Commission is around 480 billion of additional investments are needed per annum to meet the 2030 emissions reduction target. And only 250 billion of that it would come from green bonds within the next generation EU fund. So clearly a lot has to be done on the private side. Now, on the left-hand side, it's just telling us a bit about loans on the left-hand side panel, bonds in the middle, and ESG on the right. What you see is ESG is expanding the most rapidly, and equity within ESG, which is the green, is the most important. But there's still only 10% of the respective markets in the European, in the euro area. And that suggests that there's still a lot of ways to go, and CMU could make a decisive contribution. In particular, right-hand side chart, just to leave it at this, is the idea young and innovative companies are going to need financing. And we need, in order to get there, we will definitely need to think about also furthering this idea in a more integrated, resilient equity market in the EU, as well as boosting venture capital, startup financing, is certainly going to be one of the essential elements. So I'll pass back to you, Karsten, and happy to get to the Q&A.
Thank you very much, Paul. So I would immediately jump into and dive into our discussion, and I would like to ask Lina a first question. In your introduction, you focused a bit on standard disclosure, etc. So that leads me now, coming from a, let's say, very high level question. First of all, we are talking about the E within the ESG. So S and G I'm not familiar with any standards on a European level, etc. So European itself, I think even Brian mentioned it, was or is at the forefront of the green transition and has the ambition to take the lead, or even has already taken it. Is there not a risk that, for example, the big rivals from a continental point of view or a regional point of view, like the US or even China, come up and take over by setting their standards? So they are overtaking us in this long run, because that's not a sprint, it's more marathon.
Yeah, I think there's not an easy answer to these questions. And of course, I have to be a bit diplomatical maybe on that one. Sure. But let me give you a few observations maybe from my side. So first of all, let's be honest, somebody has to take the lead, yeah? If we read through most of the recent reports on climate change, we can honestly say that we have left the problem develop far too long without doing anything, yeah? As the slides of Paul have shown, climate risks are quite different from between different European member states, but they all are at risk of climate change-induced physical hazards. If Europe's member state would have taken individual action, they would have had no impact at all, I guess. Taking united action in the EU context means that the third largest economies in the world with the third largest purchasing power is taking action. Action from Europe in this sense cannot so easily be ignored and is a so necessary incentive for other economies to follow. Everyone knows that climate change is a global issue and that needs to be addressed, of course, globally. Otherwise, you won't solve it. And therefore, without any doubt, we need global standards and not only European ones. Taking the lead offers, of course, the opportunity to influence global standards. It could also prepare Europe's companies to lead in developing solutions to address climate change and export them. But taking the lead, of course, has as well a flip side of the coin. There are some risks inherent. Being the first one always comes with a side effect that you cannot foresee. Overleading economies may impose different standards a global level to those in Europe, so develop other standards. This would mean an adjustment by European actors who will have already invested in European standards first. The International Sustainability Standard Board, which was recently announced and built up in Frankfurt, showed that the creation of which was, so that will be a good test to see how this will come out with Europe having already moved forward on this one. And as looking at the disclosure risk requirement, which I was already mentioned. So I guess if we take that as an example, we can see whether it was, and I guess it was a good thing to set an example for the others.
Okay, thank you, Nina. Cool. Quite a very diplomatic answer, so that's fine. Brian, I have a question in your direction. I mean, thanks for your statement on the lessons learned, especially from the time you were a member of the European Parliament on missing to set up or to finalize the CMU. But is now green financing, I mean, we have not completed the CMU, we have not completed the banking union, so the deposit insurance is still, let's say, outstanding. So is now green financing a little bit the savior for establishing the CMU? Can green finance substitute, let's say, this missing link on let's say, political effectivity or efficiency? How do you see it?
I think it can contribute, but it goes back to Paul's point. I mean, we've done well on the issuance of green bonds, but we probably have not done as well. We haven't done as well when it comes to green lending across corporates, SMEs, and individuals. And that's really when the challenge will emerge here. Now, in our own jurisdiction across our own banks, we're beginning to see a very significant product diversification in this area. And that's really when I think that the challenge will be to, can we get actually green finance working in a way where the retail side is just as dominant and strong as the corporate side. I think that the other challenge, I think, and I think Paul was very clear in what he said. I mean, we have a good tradition of two things. We have a good tradition in Europe in actually implementing things across the European Union or even across the Eurozone, frankly. We have a lot of law and not a very distangled way in which we actually implement that. And I think if we're going to be successful in green finance, it has to be done on a more consistent basis, in a more integrated basis. So I agree with Nina on things like EU taxonomy, disclosure regs. We've started doing that, but we're not there yet. And when we get there, it has to be done in a much more consistent way. And the other point is, what Paul said is absolutely right. We have a very bad record in Europe, particularly when it comes to some of our younger, more agile digital businesses and taking them forward. What I talk about here is step finance or VC finance. In a way, the Americans, I think, are more successful. Frequently people sell out early, and we don't see the full potential of those businesses. It seems to me that they're the kind of businesses that we need to support. And I think having the kind of VC capital culture in Europe to support those businesses going forward will be absolutely crucial. So, looking back in 2015, the world is a different place than it is now. The crisis we've gone through in the last 2 years will be different to the next crisis. We're living, relatively speaking, in good times in terms of deposits and savings, and a pretty good trajectory for the Eurozone over the course of the next 24, 36 months or so across the economic situation. Well, what about bad times? When bad times emerge again in terms of the fiscal side, what impact will that have in terms of the appetite for green finance? So I think that must inject some urgency. And my central point is we can't repeat the mistakes of the last time. And that requires a much more integrated EU response to this, which doesn't allow opt-outs, which doesn't allow kind of, as I mentioned in my remarks, withholding tax to be so disaggregated member state by member state, and dealing ultimately with the SDS and securitization issue, which is fundamental to capital markets union if we're going to succeed.
Thank you, Brian, for this comment. Paul, banks, coming up from the ECB, the SSM, your passport total sitting here in front of the audience, banks tend to lend to collateralized industry, which is composed of a lot of traditional companies, I would say brown companies maybe, for example, but climate change requires investment in innovative companies that may not have a lot of collateral to offer. So is the banking sector in general, you can be even diplomatic like Lina, still the right player or the only right player to finance the transition? Do we have to broaden our view?
Yeah, so which is true. I think that banks, for reasons of risk management, surely are quite interested usually in looking at lending to incumbent sectors with lots of collateral that can be posted. And it's an understandable consideration, of course, when you're thinking about your credit or potential market losses at hand. What is true is, of course, though, that as we move forward, and I think that point's been made, is that we need some degree of heavy lifting, which is distributed across the banking sector and also the markets, and to work in tandem would be great. No, what is true is that I think with common supervision of the SSM, obviously we have some degree with banking union. It's not quite there yet, but we've made some progress. CMU would be certainly very useful as well, to be a complement. Now, specifically in the green space, what we see is actually something quite interesting, which is the degree of integration here is quite important compared to the degree of integration in the broader market overall. What do I mean by that? It's that green bonds in the euro area, which are issued here, are about twice as likely to be held cross-border by euro investors than euro issued bonds overall. And so that relatively low home bias suggests there's quite some potential there for the green markets to also act as somewhat of a catalyst as well to move this forward in conjunction with the next generation EU fund as such. No? So back to your point, I think, and Brian has made the point too, I think it's this issue that, banks will and are very important in terms of their lending decisions. We still are in Europe a predominantly bank-based economy with a lot of SMEs in the mix. And that needs to occur via banks. Now, arguably, some form of carbon taxation, which is foreseen in the expansion of that carbon taxation, will be critical in removing some of these allocative inefficiencies we have in the system now. But it cannot go the entire way to thinking about the really risky stuff like venture capital as such. And that might be a place where we'd expect a market complement. And here, integrated markets are very important. Insolvency laws questions, which plague, you know, the CMU in general, not just in the green component, in this harmonization. All of these moving parts have to move forward at the same time. And again, I think we can see the green as a litmus test that home bias need not be as strong as it is in the general bond market. If you move into a situation where we have a collective responsibility and action to take together, and their economic benefits of doing so.
Okay, thank you, Paul. With regard to the time, I would ask another question for each of you, but with a request to maybe a short answer. Nina, in your direction, because you focus or pointed out that you were looking on the retail investment perspective of the ESG issue. What are your expectations on foster or to improve the retail investor situation? Or is there any need for improvement?
Yeah, as mentioned, yeah, it's on, okay. As mentioned earlier, the retail investor should be able to see some real progress in the coming years, but not all will be perfect as the legislative framework and the required information is becoming available in phases and different implementation rounds will be necessary on the banking side. I guess we must first and foremost ensure that the inconsistency in the disclosure rules are ironed out so as to avoid a greenwashing and that access to quality data available is achieved. The next question is whether retail investors really understand what they are being asked and which information they are being provided. This is where the ESG changes to MiFID rules come in. There is still quite some ground to cover there as well, I guess. As from August 22, our banks must be applying now, as mandated by the new MiFID Delegated Acts, the ESG requirement regarding investment advice, product governance, and sustainability tests. So clients will have to be asked by the ESG preference and sustainability questionnaire will have to be adjusted to incorporate all these clients' need preference in terms of sustainability investment. So to make sure that this works in practice, the ECB and other associations representing distributors are working with the association representing product manufacturer to identify common standards and minimum sustainability criteria for an ESG product. Without such common standards, a client from a cooperative bank looking to invest in a fund might get two different sets of information presented to him between what the fund manager provides and what the bank provides. Just let me finish. The work on these standards is challenging as not all related taxonomy and disclosure definitions are clear, nor is the legislation that defines the technical screening criteria that should help us determine if a product meets the environmental objectives defined by a taxonomy regulation published. It would be helpful if compliance with such delegated acts is not made a supervisory priority until all knots are tied. One final note, maybe it would also help if pre-contractual information requirements under MiFID, PRIPS, etc. could be simplified. There is a risk that retail investors will be discouraged to seek ESG investments if they are overloaded with a complex information like in case of MiFID. Avoiding this situation will certainly help retail investors and support the green transition. Thanks a lot.
Thank you, Nina. The last question, maybe because we are running out of time in 2 minutes time. Maybe maybe Brian, but Paul, if you wanted then to add, please feel free. We were talking about taxonomies and data technologies, but we should not forget the people behind it, because a couple of years ago we looked for nerds, people who were able to be mathematicians or physicians, whatever. Are we going to see enhanced requirements on the qualification, let's say on the different levels within the banks, like board members need to understand a bit more like than what ESG is standing for? So are there new requirements in the application of financial employees necessary or to be expected anyway?
So I think it's a fundamental question, because we're only going to get there if we have the skills there. and we don't have the skills there currently in the scale and capacity. We're running a program here in Ireland, which is publicly and privately funded, called SkillsNet, which is around trying to enhance existing bank staff, to make sure that they have all of the information and knowledge requirements on the disclosure front, and to make sure that they're fully compliant, because a huge part, of course, of a modern bank is around compliance. So that's another example of kind of public and private working together, which I think we need to foster. As I said earlier, the COVID experience might help us do that. So there's a big push on the skills across the banking sector needed in Europe, but equally so, there's a big push that's needed at a governance level across ExCos and board level to make sure, as I'm sure people are becoming more and more aware of, that the right skill set is there. And it's not just at a climate change level and ESG level, but it's across the totality of ESG, because it's crucially important that responsibilities are understood in terms of the governance of our institutions as we go forward.
Okay, thank you, Brian. Paul, I hope you don't mind if I shut down the discussion. I know I still have some pages of questions, but it's already 4 o'clock, and that means we have to finalize a very, very fruitful and lively discussion. So many thanks to you three for participating in that panel. I would then close the session 5, and now it's up to me. I have the honor now to close the 14th European SSM Round Table. And first of all, I would like to thank the Maliki Group and firm who set up and organized this event, especially to Mrs. Julia Knopp, who was the leading figure behind the scene. I also would like to thank the Central Bank of Ireland being host of the roundtable today. I'd like to thank all the audience over the whole day, followed the different topics, all moderators and all panelists. And I would like to invite you to the 15th European SSM Roundtable, which is going to help take place in Brussels. So the National Bank of Belgium is the next host on the 25th of May 2022. So maybe I can visit then Nina next year, hopefully in person, but we still have to overcome the COVID issue. Therefore, please stay healthy. All the best to you and your family. God bless you. Goodbye. Thank you. Bye-bye.
Thanks a lot.